Good morning, everyone, and welcome to the June 22nd, 2026 meeting of the Governmental Accounting Standards Advisory Council. My name is Rob Hamilton. I am the chair of this council, and it is my pleasure to welcome you here this morning. Hope you all had a nice, uneventful trip in, the best type of travel, I think, that's going on. And so I also wanted to say it was a very pleasurable dinner last night, meeting a number of you and getting a chance to catch up. And it's always such a great time for conversation and camaraderie. I wanted to take a moment here and welcome a new member of our council, Joel Levy from the ICI. He is our new council member. And so if you get a chance through our breaks or our lunch, please be sure to welcome Joel to our council, and excited for his contributions in our council. As we normally do, we'll go around the room and do introductions. If you could share your name and your organization and then the constituency group that you represent. I'll start to my left, but as you do, just as a quick reminder, you'll want to hit the speak button on our microphone, give it a beat. You'll see it turn green. That allows the camera to come to you, and then you're able to share your comments. So with that, again, Rob Hamilton. I am from the National Association of State Auditors, Comptrollers, and Treasurers, or NASAC, and I am the state controller of the state of Oregon.
Good morning. I'm Harriet Richardson. I'm the retired Inspector General for the San Francisco Bay Area Rapid Transit District, and I represent ALGA, which is the Association of Local Government Auditors.
Good morning. I'm Chris Jumper. I represent bond insurers. I'm Managing Director at Assured Guarantee.
Good morning. I'm Abel Palacios. I'm Vice President of Finance with DFW Airport, representing Airports Council International.
Good morning. I'm Tyler Montana Prescott. I'm the Clark County Revenue Commissioner in Alabama, and I represent NACO.
Good morning. I'm Dean Mead. I'm a partner and government public sector subline leader at Carr, Riggs & Ingram, and I'm here on behalf of the National Federation of Municipal Analysts.
My name is David Goldman. I'm the Deputy City Administrator and Finance Director for the City of Oak Harbor, Washington, and I'm here representing the National League of Cities.
Good morning, Robert Scott, GASB member.
Good morning, Diane Ray, GASB member.
Bob Scott, I'm representing GFOA.
Morning, Elizabeth Thomas. I am representing the National Association of Bond Lawyers, and I am a partner with Butler Snow in Denver, Colorado.
Good morning. I'm Debbie Miller. I am the Chief Fiscal Officer for the Illinois State Treasurer, and I represent the National Association of State Treasurers.
Good morning. I'm Jamie Wyman. I'm the Director of the Tennessee Consolidated Retirement System, and I'm representing the National Association of State Retirement Administrators.
Good morning. William Blend, representing NASBA, National Association of State Boards of Accountancy.
Hi, I'm Stephen Stewart. I'm the Research Director for the Bureau of Governmental Research in New Orleans, and I represent the Governmental Research Association.
Hi, Jeff Praviti, GASB Vice Chair.
Sam Rippin. I'm the Chief Financial Officer of the Peabody Public Schools in Massachusetts, and I represent the Association of School Business Officials International.
I am Anita Kovacs. I am the Vice President of Business Affairs for Pensacola State College, and I represent NACUBO, which is the National Association of College University Business Officers.
Good morning. Michelle Waterworth. I'm a partner with Plant Moran, and I represent the AICPA.
Carl Citroen. I'm with Conning Asset Management, and I represent the insurance industry investors.
Sean Hunstock, Controller with Snohomish County Public Utility District, representing American Public Power Association.
Good morning, Darren Tarleton. I'm an audit partner with Forbes Mazars, and I'm representing the Healthcare Financial Management Association.
Morning, everybody, and welcome. I'm Joel Black. I'm the GASB Chair.
Good morning, Alan Skelton, Director.
Good morning. I'm Christine Brock, representing the International City Managers Association. I'm the Assistant City Administrator, Chief Financial Officer for the City of Franklin, Tennessee.
Scott Deviney. I work for the Office of the Washington State Auditor, and I represent AGA.
Good morning. I'm Linda Ragland. I represent American Accounting Association. I'm an accounting professor at the University of New Hampshire.
I'm Bob Bland. I'm representing the Association for Budgeting and Financial Management. I'm retired recently from the University of North Texas, a professor there, and most recently also taught at my alma mater, Pepperdine University.
Good morning. I'm Sophia DiCaro. I'm the Executive Director of the Utah Governor's Office of Planning and Budget, and I represent the National Governors Association.
Good morning. Chris Knight, GASB member.
Good morning, everybody. My name is Erin Hill. I'm the Executive Director here at the Financial Accounting Foundation. Welcome to all of you to our offices today. Thank you.
Good morning. I'm Pam Dolan, GASB staff.
Kara Deanna, GASB staff.
Good morning. I'm Emily Paul, GASB staff.
Good morning. I'm Carolyn Smith, GASB member.
Good morning. I'm Jackie Reck, GASB member.
Good morning. I'm Patty Mitchell, CFO for Forest County, Potawatomi, and Wisconsin, and I'm representing NAFOA, the Native American Financial Officer Association.
Good morning, Rob Weber. I'm a credit analyst at Moody's Investor Service, and I am representing the bond raters.
Good morning. My name is Joel Levy. I work for Nuveen Asset Management as a portfolio manager, and I'm here representing the Investment Company Institute, ICI.
Good morning, everybody. My name is Lisa Parker. I am a member of the GASB staff and extremely honored to serve as your GASAC coordinator.
All right, thank you, everyone. Next up, I wanted to cover the minutes from our last meeting that was included in the packet of the materials that you got in advance. Is there any discussion on those minutes? Seeing none, can I get a motion to approve?
Motion.
Thank you, Elizabeth. A second? Thank you, Sophia. All in favor, say aye.
Aye.
Any opposed? All right. Minutes are passed unanimously. Before we move on to the next item of the agenda, I just wanted to take a quick moment and say, as you have comments, the way we'll go through and do these is you'll add your name tent on its side. That way that indicates that you have perspective to share. And I do, again, want to share and that this is such a unique opportunity that we do have in front of the board and the staff to be able to share our perspectives. Silence doesn't indicate whether we agree or disagree with the questions that are being posed. So really want to encourage people to share their perspectives and their whys for the answers that they provide. With that, I will turn it over to Erin Hill for the report of the Financial Accounting Foundation.
Okay, thank you so much, Rob. And again, good morning, everybody. I'm pleased to share a brief update on key activities at the Financial Accounting Foundation over the past several months since I last had the pleasure of seeing you all. Before I turn to the trustees' May meeting, I want to briefly highlight a couple of key foundation stakeholder outreach efforts. Since the beginning of the year, Dahlia Blass and I, our new board chair, have met with a broad range of leaders and organizations to hear their perspectives on financial accounting and reporting on our foundation and feedback on how we're doing and the oversight that we provide at the Financial Accounting Foundation. To date, these conversations have included more than 70 leaders from regulatory bodies and stakeholder organizations and Capitol Hill. Most recently, Dahlia, myself, and several other members of the Board of Trustees went to Montreal and met with the International Financial Reporting Standards Foundation, our counterpart to the FAF in Montreal. So we had the opportunity to meet with them, their executive board, as well as their entire board over dinner and talk about shared issues and concerns and opportunities. So I think it's really important, and I want you all to hear this, not just as a GASAC at large, but individually for your organizations that you all represent. If you have feedback, if you want to share your perspective with myself, Dahlia, please don't ever hesitate to reach out and get on our calendars. Be delighted to talk to you. We're committed to making this outreach a regular part of our stewardship of the organization, and we value your perspectives and look forward to continuing this dialogue. Now I'll turn to the May trustees meeting, which was in Washington, D.C. The board approved several important appointments and reappointments and recognized 2 members who were completing their terms. To begin with, Jackie Reck was appointed to a 1-year term as the GASB Vice Chair effective July 1st. Jackie has served on the GASB since 2022 and was reappointed to a 2nd term in 2025. Jackie, thank you for your leadership and for assuming this responsibility. We very, very much appreciate that. The trustees also approved the reappointment of Jerry Shawver as the chair of the Private Company Council for a 2nd 3-year term effective January 1, 27, along with the reappointment of 3 council members, David Finkelstein, Bradley Hendricks, and David Hoagland for additional 3-year terms, also effective January 1st, 2027. In addition, as Rob just mentioned, the trustees approved Joel Levy as the Investment Company Institute as a new member of this council. Congratulations to you, Joel, and thank you for your leadership. We look forward to your contributions during your term. The trustees also recognized Jeff Praviti here again today, who will complete his service as GASB Vice Chair, as well as that of Dr. Christine Bodison, who will complete her 2nd term as a FASB board member, both of whom's terms complete on June 30th, 2026. I know there'll be an opportunity for more discussion of that, I'm sure, Joel, but I just want to say on behalf of the Financial Accounting Foundation, a huge thank you to you, Jeff, for your leadership and contributions over your very distinguished tenure here. I also took time to recognize the Foundation's Chief Operating Officer, Mary Crotty, who officially retired or is officially retiring on June 30th. As I shared in that March report, Mary's departure gave us an opportunity to re-examine the Foundation's organizational needs and ensure we're positioned to continue supporting the standard-setting boards effectively. So as part of that work, we have launched a search for a Chief Technology Officer. This role will be important in helping us develop a strategic vision for our evolving technology needs and ensuring that our technology investments support the organization's long-term priorities. So we have posted that position, and if any of you have a friend or colleague who's a rock star Chief Technology Officer, welcome the introduction and the referral. This role is incredibly important to our future as technology continues to change, rapid evolution. It would be great to have someone that is known and trusted. Lastly, I want to underscore the significant responsibility of the Appointments Committee this year. It has been incredibly busy, but it's been a joyful process because the committee is recruiting exceptional talent for several roles, including, as I mentioned at the last update, the FASB chair, the GASB chair, 3 new FAF trustees, including 1 governmental trustee, and 1 new member each for the FASB and GASB boards. That is a huge lift for the Appointments Committee. It's something myself and my team in HR are spending a great deal of time on, and we are really delighted with the quality of the candidates that are in front of the Appointments Committee for consideration. In addition to those leadership searches, of course, the Appointments Committee continues to identify qualified candidates for the FASB and GASB advisory roles, as indicated here with Joel's appointment. I'm pleased to report that these searches are progressing extremely well. We've identified strong finalist pools for many of the roles and expect to announce appointments publicly after the November Financial Accounting Foundation Trustees Board meeting in Norwalk. Some announcements may come sooner depending upon the committee's progress. Finally, a couple of other things that happened in the May meeting. The board approved the continued engagement of BDO as the FAF's independent accountant for fiscal 2026. We've also engaged BDO for an audit-related internal controls engagement. We also approved JP Morgan as FAF's new investment manager. This decision is part of a broader review of the Foundation's financial operations, including investment policies, asset allocations, cash management, banking relationships, internal controls, and reserve fund policies. These actions all reflect the trustees' continued focus on financial stewardship, sound oversight, and disciplined risk management. You have my commitment that I think about this every single day. We are responsible on behalf of all of you and all of your stakeholders who entrust us with this responsibility and with these funds. And you can know that I take that responsibility incredibly seriously, and I'm committed to ensuring we're doing the right thing and being proper financial stewards. Finally, the Financial Accounting Foundation published its 2025 annual report. It's available on the FAF website. Got some cool pictures in there. Some of you are in there. Take a look. The report includes the foundation's full financial statements along with a recap of major FASB and GASB activities during 2025. I encourage you all to have a look at that and to, again, share feedback. Next year will be a really important year because it will be an opportunity for us to reflect on the 7-year tenures of both Joel and Rich in their accomplishments at the FASB and GASB board. So we look forward to any feedback that you might have for next year's annual report. And with that, I will conclude my report, and I'm happy to answer any questions that you may have. Again, my office is right over by the dining area. Please stop over, say hi. I'll be stopping in and checking in, but I'm here at your disposal. And again, welcome to our offices, and I wish you a great couple of days of meetings. Thank you.
Thank you, Aaron. Questions for Aaron? Seeing none. Thank you so much.
Oh, come on. One. Thank you, Rob.
Yeah, thank you. Next up, we have the report of the GASB chair. I'll turn it over to Joel.
Thanks, Rob. Welcome again, everybody, to Norwalk. It's been 6 years since I left public accounting practice and a seat on this advisory council, but I haven't forgotten in those 6 years what it was like to have that full-time job and then volunteer your time. And it's a lot of time that we ask of you to read these papers, to travel to Norwalk, to participate in these meetings. We're asking a lot of you, but I can tell you as a board member that all of the board and our team of staff really value the input you provide. And so it's a worthy investment, but thank you very much for making that investment of your expertise and time with us. My report, I have the first quarter report, is in your materials. I'm really going to primarily focus in my comments on updating you since my last report to you at the end of March. During that time period, we did issue the exposure draft on infrastructure assets. We appreciate your comments on that project along the way, including at the last meeting. Appreciate those of you that have provided comment letters already. Would love to see even more comment letters from more of your organizations come in as the comment period does end at the end of this week. We are holding a series of 3 public forums, of which the first is actually tomorrow here in Norwalk, and a good many of you are actually participating in that and or staying to observe that. So thank you especially for sharing your time with us on that, and we look forward to that opportunity to hear your comments. In May, after kind of all of the research on cybersecurity risks, your input in particular at the last meeting in March, the board did vote whether or not to undertake a project on cybersecurity risk disclosures and voted not to undertake that project for many of the reasons that many of you articulated at that last meeting. But primarily, we just couldn't find a standard setting path to go in between either the result being boilerplate disclosure that's really not very useful to anyone, or disclosure providing those risk conflicts that we talked about in our research paper and providing harm to a government in their cybersecurity posture or adding to their risk by the sheer fact of the disclosures we would require. And so we just said it's an important issue, but it's just not a place for the external financial report to weigh in on that. Also in May, we approved the tech plan for the second third of the year. There were 2 additions to the pre-agenda research activities of the board in that approval. I'll talk about those in a minute as my remarks go on. We continue to be very focused on only undertaking projects that are, in our view, significant improvements to the financial report. I talked about my views on that significance with you last meeting. If not more than that, the three buckets, kind of things users want, external financial report is the right place for it, gaps in GAAP, or we can actually significantly improve the report by simplifying requirements or reducing complexity or reducing the amount of requirements. And so we rely on our stakeholders to tell us what those things are that might fall into those buckets. What are the things that we should be working on? And we listen to our stakeholders, and you guys are a primary part of that, representing so many of our stakeholders, including at the annual prioritization, which you did at the last meeting. And so I wanted to kind of highlight, in my view, I look at kind of the cutoff for me was really the top 7. There was a top tier of 2 or 3, and then there was another tier of votes from your prioritization. And so I'd like to talk about our thoughts on those top 7. The highest ranked project, as you might recall, was digital assets. And that is one of the 2 pre-agenda research items that was added by the board at its May meeting. We elevated it from monitoring to pre-agenda research. That research is really going to, through our monitoring, we know some of the places, and through your input, some of the places and ways in which governments are utilizing digital assets. But the first part of the research, we're really trying to do a broad search for those items so that we kind of have a full, more encompassing view of how many and what kinds of digital assets governments are utilizing and how are they utilizing them, so that we can then go to the next part of the research, which is really kind of putting those uses, at least the ones that have prevalence and significance, into ways in which standard setting could address them. There might be some of those items where implementation guidance, where current guidance works, but implementation guidance then might be necessary. You guys gave us some good examples of maybe some of those things at our last meeting. There could be areas where actually standards currently don't work for this item, and we might need a standard setting project to address those specific cases. And there may be parts where digital assets just aren't evolved enough for us to address them for our by standard setting at this point in time. But our research is going to put all that together and give us a good standard setting path, so that when or if we undertake a project for those, we'll be able to move through it pretty expeditiously. So that's the first item. Second item in your ranking was government fund financial reporting. I agree, it continues to be significant. I still think maybe a little more time needs to pass from our financial reporting model project so we can really start fresh, but certainly we understand that's a priority for you. The third was the financial reporting entity. We've talked with you guys about that. It's been pretty high on your prioritization for the last several years. We've really tried to hone in on maybe what some of the problem areas are, and the board will later this week, because of your input and that input of the things you were concerned about, vote on whether or not to add that additionally to the pre-agenda research. So it's not yet there. We'll see what the board votes on later this week, but we are, at least the team has brought a proposal to the board to add the financial reporting entity to the pre-agenda research. Fourth, and kind of the next year, was gap structure. That is in our research already, so it is something that we're working on. We did release the discussion memorandum after the last meeting, so we got some of your input. We got board input and finalized that discussion memorandum. So it is out for public comment. So we do have some of your feedback on the DM, but would love your comments more fulsome in a comment letter. We have a pretty long comment period on that, so it goes through the end of August. And so look forward to your feedback on that project. Fifth for you was fund balance. To me, that one kind of creeping up that high was a little new. Kind of love to get, informally some of your input on what is the challenge, like what is the standard setting project, what about the standard needs to be improved or is hard to understand, et cetera, about fund balance, so that we can kind of figure out how to move forward or address that issue. Sixth on your ranking was pension and OPEB deferrals. This was the second item that the board approved in May to add to our pre-agenda research. So we are moving forward with pre-agenda research on looking at really the effect of deferred inflows and outflows of resources on pension expense, so that we can then be informed about, how significant is that impact and make decisions as a board about any potential paths to move forward related to something we heard in the post-implementation review was really challenging and costly for you. So we want to make sure we kind of understand maybe the benefits of those deferred inflows and outflows on pension and OPEB expense. And the first step of that is gathering information about what the impact is. So we are starting that research. Seventh was technology and governments, in particular, focus here on how governments are using technology differently or to differently prepare financial reports. That's something that's very interesting to us so that we understand how technology is evolving that, what that means for us as a standard setter, what we can do to help facilitate it, or how we might need to react or change or respond differently. So certainly as you're seeing that in your practices, in your governments, love to hear information on how technology is really changing financial reporting, if at all, at this point. So those are the 7 highest ranked priority items that you guys provided us and how we are responding. Again, that information, that input is really valuable to us. So at this point in time, we have 4 standard setting projects. I already mentioned 1, infrastructure. So we won't cover it today, but we have the public forum tomorrow. The other 3 projects, we will get input from you today: revenue and expense recognition, our going concern severe financial stress project, and our implementation guide update or on subsidies. You guys will be hearing about later today. Finally, our voluntary digital financial reporting project did want to note that it continues to move forward. I would expect a discussion memorandum. We kind of updated you on that project last meeting, I believe. We won't update you here at this meeting, but we do expect a discussion memorandum to come out in August. I think of note that the Financial Data Transparency Act, which may or may not be related to our digital financial reporting project, which for many of these meetings I've said nothing's really happening. Well, the joint rules finally did actually pass a couple of weeks back. Our view of those were that there's nothing really in those rules that impacts, I think, municipal securities, or at least the financial reporting part of financial or municipal securities directly. And so they really left a lot of that to the SEC in the next phase of FDTA rulemaking over the next couple of years. I can tell you that we continue to update the Office of Municipal Securities on the progress of our taxonomy project. So to the extent they think annual financial reports needs to somehow implement or utilize FDTA in some way for those reports as they're being submitted to the MSRB, to the extent they would want to utilize our taxonomy, we hope that they would be interested in doing that if that is a path they choose to take. And they remain interested in our project, asking questions. We just updated them last week, actually, on that. Finally, I'd like to, while it's not maybe her first official meeting, our next board member, we love Jeff and we're going to celebrate Jeff at the board meeting, but Lisa Washburn, we announced this at the last GASAC meeting, will be the board member that's replacing Jeff, and Lisa is actually here today. And so she's observing and really ramping up and getting ready to become a board member. And so we're excited to have her here. And you guys, some of you may be familiar with her because she's not been that long that she's been off the GASAC and was one of you guys, but we're excited to have you, Lisa, on the board and appreciate you being here. With that, Rob, I have concluded my report, but I'm happy to answer any questions anybody has.
Thank you, Joel. Any questions for Joel? Dean?
Dean Mead, NFMA. I've had the pleasure of attending quite a few GASB updates recently at various conferences with Joel and Alan, and you routinely make the point that you made during your remarks this morning about the shift in your criteria for adding projects, which is, my observation, been generally received with euphoria at those all being preparer and auditor conferences. And so I need to say again, as I've said at prior meetings, that NFMA does not believe that this the approach that the board has been taking for the last couple of years is in our interests at all, or in the interest of achieving GASB's mission. And so the question we have is when this is going to stop. I, as a GASB staff member for almost 25 years, I heard repeatedly preparer and auditor organizations asking when was GASB going to stop issuing standards, and our question is when you're going to start doing it again. We think the bar is too high, that it can only be a major improvement to the financial statements, and we would observe that the absence of small, narrowly focused projects on the agenda, doesn't serve us or preparers or auditors, because those types of projects often make life easier for governments. They resolve, minor items, things that probably don't improve the information that we see in the financial statements, but can resolve a sticky issue for governments, and that's in our interest that the overall burden on governments be lessened. And there's so many GASB statements that wouldn't meet muster under the approach you guys are taking now, that you'd never start those projects, and yet they with very little effort on the part of the government, solved issues that aren't home runs, but are important to the governments that they affect. And so, we would like to know if this is permanent, or if we're going to come to an end of the period where this stops and the board ramps up again its standard setting activities.
Thanks, Dean. Appreciate the comments. I would say the first bucket, the significant improvement, is us listening to users. And when you're asking for information that needs to be changed or added to in the report, that's a worthy endeavor for us. I would argue the infrastructure project, not terribly popular with the preparers, and as an example of us listening to users and trying to improve the information or add to the information that's in the report. And to your point, to the extent, that's why we're listening, right? If there are complexities, sticky issues in practice that are causing problems, let us know about them. When we have enough to accumulate an omnibus project or whatever that, collectively is worth kind of making that investment by everybody, then that's something we'll do. We're not against that. But so we're listening to our stakeholders in all cases. So ramping up or down, in my view, and I'll be here another year and we'll see what happens after that, right? But in my view, and I think our board that we have currently's view, is that we're trying to work on the things that we think maximize benefits and reduce costs.
Thank you, Joel. All right. I just wanted to quickly say welcome to Lisa as well. I appreciate you the call out, and as a former vice chair of our council as well. So excited for her start on the board here next month. With that, I'll turn it over to Alan to give the report of the Director of Research and Technical Activities.
Thank you, Rob. I appreciate that. It's funny. Joel started out his comments referencing back to GASAC, and I was writing talk notes before today, and I was actually thinking about the fact that today would have been 11 years since I first started doing GASAC. To get perspective, I was on GASAC before Jeff was on the board. I don't know why, Jeff, you leaving, that resonated with me, but when I realized I've been in this room in some capacity for longer than you've been on the board, it's like, wow. I say that, but then I say that again to say that I used to love these meetings when I was on GASAC, and I continue to love them now that I'm in the role I'm in now. And so just thank you for being here. Thank you for taking your time. To Joel's point, you've got day jobs you've got to do, and you take time out of your day to come here. And so we really appreciate that. And so thank you for that. It's funny. So this is why I always want to go second. I don't know if anybody can see this, but see all the orange on this sheet? These were things I was going to talk about, but Joel just did.
I knew I was going to talk about.
We talked this morning. We actually did. We actually did talk about this morning. And which is why you make the notes. And ironically, a lot of the things that I thought I might want to talk about, he already covered. So my list will be somewhat a lot shorter, and that's okay, and that's fine, because we don't need to talk about it twice. I'll touch on one topic he mentioned, just to throw it out there. He mentioned the infrastructure project and the exposure draft period. The comment period will end on Friday. We will have a public forum tomorrow, as he knows. There's also 2 virtual public forums, one on July 13th and one on July 23rd. Those are virtual. They're not in person. So anybody in the room that maybe observe tomorrow, and observing tomorrow, you're like, I really would have liked to have said something. But because I was observing, I didn't get to say something. There's still time to put your hand up and be part of that July 13th or July 22nd virtual public forum. And if you do, that's awesome. We think that's a really good format and a really good function. And those of you that are going to stay and observe tomorrow, we really look forward to you observing that. We think it's a very popular thing, but I just want to mention the 2 virtual ones that we still have out there. So last, I'll get to the stuff at the bottom. I guess the stuff at the bottom of this page. In no real general order, I'll touch on the first one, just being materiality. I will tell you that that's a topic every time I go into a GASB update anywhere. It's a topic that continues to get a lot of conversation. It continues to get a lot of discussion within governments, especially local governments. It is not unroutine for me to be in a conversation with somebody at a GASB update. They'll be talking about some standard. I say, let's open up your ACFR. They open up their ACFR. We went to a line item, whether it be leases or speedes or compensated absences or whatever it might be. And very quickly, without doing any math, you can look at the number and know that number is immaterial. Not part of it, the whole thing. The entire speed of balance they reported, the whole thing is immaterial, which makes me worry that we still don't, at least at the prepare level, have our hands around materiality. It's a new thought, new concept we're talking about, so I understand that, and we appreciate that, and that's why we've been talking about it. I will say a couple things on that front. The California State Fiscal Managers Organization, CSFMO, can never say that right, just put out a paper on materiality. It's what they consider to be a permission sheet or how to leverage materiality. It's really talking points that they've given to all the local governments in California about how you might start having this conversation. It does not answer all the questions. It's not going to answer all the questions, but at least it's an initial conversation. I will say that's been picked up probably at the national level by the national GFOA, and they're talking about that now, and they're doing work on that now, and they're putting some tools together to actually help governments actually think about how to address that. And there's a session at the National GFOA conference, if you're going, on this topic, and I think it'll be a topic we continue to talk about for a while. But it is important because, as I've said before, if we all have limited resources and too much work on our plate, and we've got a tool that we can use to actually reduce the amount of work we have to do, then why aren't we using it? And so that's just a talking point that we want to talk about. AI at GASB. See, we can't go to a meeting now. Can you go anywhere that mentions the word AI? Okay, so I'm going to do it for us today. So we'll do it right off the bat, and we won't have to do it any further. But we are actually dealing with some products with AI here at GASB, and some of them are just routine things that we deal with when we're trying to write board papers or give the board information, or turn meetings like this into summaries and using ChatGPT to actually turn this into a summary, or liaison meetings with HFMA or something like that, turn that into summaries. But there's 2 things we're doing that I'm really excited about that I think could have some long-term ramifications. Number one is we're actually building what I would call a search overlay on top of our COD. And right now, the way we search GARs is we search GARs using keyword search, and keyword search has limitations, right? You have to manage, you have to train, you have to understand what the keywords mean. Well, we're actually using Claude to actually put an overlay on top of it to actually do contextual searches, not just keyword searches. You first hear that and you're like, well, I don't know how that could be better than what I could do. I could just go in there and I can search the term and I can find the answer. And then you see what this tool returns, and you're like, wow. As someone says to me a lot, I'm in love with this guy. We've decided, I don't know why, but some people internally have decided Claude's a guy. I'm not really sure why that is. Don't ask me. I guess the Claude name guy. But it's pretty impressive. We're doing it internally at FAF, actually, not even for us, but also for FASB's ASC. And potentially a really cool improvement to how we actually interact with our codification. I think that's a really cool thing. The second one is the one that's I get really excited about. As y'all know, when we at the GASB want to do research, right? And we want to research, even like, and Linda would understand this, and or I know Jackie does. I want to do research and I want to go look at governments. How do we do it? I've got to go find the same PDFs y'all do. I've got to go download those PDFs. I got to open those PDFs. I got to go search whatever I want in the PDF. I got to put it on a spreadsheet. And yet with this really complicated multi-tab, multifaceted spreadsheet with a lot of data points on it. Well, that's a lot of manual steps to get to a number, to then get to do your analysis, right? And what that does in some respects is it limits the number of governments you can actually sometimes look at, right? Because it just becomes a bandwidth issue. How many governments can I find? We've been working on a tool, again, using Claude, where right now we've got an AI tool and we've tested this on all 50 states, the top 50 cities, the top 50 counties, and a subset of another 100 just governments, special districts, special purposes, just a random set of governments underneath that, where Claude will go out and find their ACFR. So if we say, go find the 2024 ACFR for any state or any city or county, go out, find it, pull it down in a repository, open it up, screen scrape the information from the statements, put the statements into spreadsheets, download the notes, and we're about to be in the process of turning all that information into a database. Now, just think about that for a minute. What that means is like we're in a world pretty soon where not only do I have to worry about sampling, maybe 300, 400, 500 governments, we might be able to have research based on 5,000, 10,000 governments, right? And that's a really amazing idea. The thing about it's interesting too is if we take the VDFR project we've been working on with the taxonomy, and you give Claude, and we're working on this right now, and I suspect it's going to work just based on some things we've seen. You give Claude the taxonomy that the team's been working on, and you say, okay, so not only do I now want you to screen scrape the statement in that position, and by the way, it found all 50 states, and by the way, it found all 50 of the top cities, and it found all 50 of the top counties. And of the 100 random governments it's found a large percentage of those entities. Not all, because some special districts, you just can't find them even manually, but it's finding them routinely. But if you were to give it the statement deposition, the taxonomy that we've created, and let it use that, can it then take that information using that taxonomy and turn it into a database? Now, if it can, then that's a really big step forward in terms of what we can do in terms of the amount of data you can get at. And I'm seeing Linda and Jackie just kind of shaking their head. But I know Rob and the rating agencies, the municipal agencies, and I know Lisa's probably there going, can I have that too? It's a leverage multiplier, right? Because now it's not about manual. Now it's not about a certain subset. It's about a bigger population, and we get a much broader idea of what's out there in the environment when we can do that. So, you can talk about AI in the sense of, well, how does it help me create a PowerPoint, or how does it help me create a spreadsheet, or how does it help me create a Word document? But this is a big deal, and we talked about this. Joel's talked about this for a long time about maybe one day we'll get to a place where AI can do this. We may be really close to being there. And so I think that's awesome. And so you can see a world where you take the taxonomy that the VDFR team is doing and these AI tools, and all of a sudden, AI or taxonomy in our world becomes less of a preparer initiative and more of a user initiative. In other words, that taxonomy is just a skill that the bot gets, the AI agent gets, that can use and actually produce information. So I can't even tell you how excited we are. I think it's amazing the results we're getting out of this thing. That's kind of where we are with AI. Just two really big things that I think are going to be really big changes and really beneficial to us internally. I think we talked about this last time, talked about some educational videos. We put out an education series of videos out for elected officials. It got put out, I think, right before this GASAC meeting last time, if I'm not mistaken. They're out on the website. There's 16 videos. It was meant to actually provide folks some educational expertise around our reporting model. There's one on MD&A, there's one on entity-wide statements, there's one on fund statements, there's one on pension, OPEB. It's 16 different unique videos, about 10 minutes each. Figuring that most folks have an attention span that's about that long. At least I know my kids only have that, and I'm getting to the point where now I only do too. But it was not done from a technical accounting standpoint. It was not done from a real, you got to be a techie GASB person to understand it. It was written for that, elected official who we sometimes think doesn't know anything about GASB. They don't really know what the words mean. And this was written to educate them. Just for perspective, I know, and I can say this pretty confidently, that we're well past 13,000 people going to this website and looking at these videos. 13,000, right? And that sounds like a lot. And then when these next two stats, the stats that pretty amaze me, is not only past the 13,000 number, but 45, 48%, close to 50% of the people that go to the website open a video. Okay, so and that's pretty impressive. And then you say, Yeah, but a quarter of everybody that goes to the website finishes at least one video. So we're just happy with the sense that like at some level, this has hit a chord, right? And it's being useful. And we're really excited about that because I do think at the end of the day, helping educate stakeholders, elected officials is important. The videos are on the website. They are downloadable. They are free. They were meant to be both downloadable and free. So if you want them and you want to download them and you want to put them on your government's website and you want to give them to your elected officials or give them to your finance team and you want to say, hey, I just hired somebody brand new and they got an accounting degree, but they don't know anything about government accounting. Here's a start. I mean, it could be a start for somebody. An elected official, brand new, give them a couple of them. I will highlight there's a couple, probably videos 3, 4, and 5, which is MD&A, the reporting model review, entity-wide, and fund statements. I think it's 3, 4, and 5. I think it's right. If you want to start with just 3 of the 16, I'd probably start with those 2. Those 3, sorry. So again, we're really happy with that. Last thing I'll touch on is just the technical inquiries. I don't think the stats will surprise anybody. I think the topic getting the most conversation right now is Statement 103. We're also right in the world of implementing Statement 103 this year, and historical trends will tell you that when you're in the year of implementing a standard, that's when those TI counts go up. And then as we've implemented it, they will go down in the preceding year or 2, and something else will replace it. So I don't think that trend really surprises me. I think it's what I would have expected. With that, Rob, I will turn it back to you if you have any questions.
Thank you, Alan. Questions for Alan? David Goldman.
So yeah, Alan, that sounds really exciting, all the stuff you're doing. So about 5 months ago or 6 months ago, I discovered Google Notebook LM. And so Google Notebook LM, and I downloaded all the GASB statement and pronouncements, uploaded it to like a project, and I just use that to query. And it gives you the sources, and I go and double check the sources, and I haven't found it give me a wrong answer yet. So definitely whatever you're doing as far as making things easier for people to find answers from all the information that GASB has out, definitely move things along quickly. Oh, David Goldman, National League of Cities.
Thank you, David. And I failed to ask that of everyone. As you do share your comments, if you could say your name and organization, it helps to orient who made the comments. Bob?
Yeah, I've watched a couple of the videos. Yeah. Excellent. And I'll say they're very valuable teaching tools that I have not yet had an opportunity to use, but very well done. The 10-minute time frame is perfect. Bob Bland, ABFM.
I appreciate that. The idea was we were pretty hardcore on this. It took us a little while to get it done. The downloadable part of that was important to us. Maybe it's used for elected official. Maybe it's used for new finance people in the new finance office, but also it can be used by the academic community to say, hey, use this to help teach government accounting in some of these classes. So very happy to hear that. We routinely get emails from people thinking these videos were good, so we're excited.
Sean?
Sean Hunstock, APPA. I'm just curious what the next evolution of those videos will be. Now that they're done, I would encourage further specialization or subcategories. For instance, a separate video just on business type activities.
You'll be happy to know that we've actually started talking about what is the next step, like what's the next evolution. That's something that's dawned on us too. I don't know that we've necessarily coalesced on what it is, but we have thought about the fact that if the response is like this to this, and we can take it down maybe to that next level, right? Of keeping it at the layman's terms, keeping the layman's perspective, but so BTA might be I think there's a video on proprietary funds, but doing a video maybe on BTA activities as a whole might be something there. So yeah, we've thought about that. Sean's a good point.
All right. Thank you, Alan. Very exciting stuff on the AI front and the videos as well. So appreciate all the work that's being done by the board and staff on that front. So the next up on the agenda, we're going to go and jump into the emerging practice issues. I know many of you have heard this before, but this is such a key area as you are in your day jobs or as you're interacting with your peers, and you hear of things that you feel like would warrant potential GASB action, this is an opportunity to share those items. So really on the kind of that forefront, that cutting edge of items that you'd like to bring to the GASB and the staff's attention. So with that, I will open it up. Anyone have items to share from an emerging issues perspective? Sophia?
Hi, Sophia DiCaro, NGA. We had a couple surface in our network. One was how to treat public infrastructure that may be purchased or owned by private equity investments. And then the other is public infrastructure districts and who's accountable to report for those. Thanks.
Scott?
Scott Deviney, AGA, same two for our group, environmental credits and digital assets. Same point about environmental credits being really big. So we're affirming digital assets getting added to the pre-agenda research. Thank you for that. But did want to make the same point again about how we feel like if we can't get projects in the near term, we should at least get implementation guidance. We know that there's answers that are rooted in existing gap, but just want to emphasize that it's super helpful to have those answers captured and citable and searchable in order to hold us over in the meantime. Thank you.
Scott, I assume you're referring like to digital assets and some of the conversation and questions we've talked about.
Yes, but also believe the same thing about environmental credits. So for example, our office, the Washington State Auditor, I mean, we've had several questions over the years. We've got TIs, but it's awkward to run for many years where we're auditing based on like, well, GASB told us this, and we can try to explain it to you, but we can't cite it, it's years ago, et cetera. Thank you.
Sean?
Sean Hunstock, APPA, and I'd just like to second Scott's comments on environmental assets from an APPA perspective. It's a growing issue. More and more states are venturing into environmental assets and carbon allowance trading and so on. There's been some action on the part of FASB, and I would encourage GASB to similarly take action as well.
Any other emerging issues to bring forward? Carl?
Excuse me. Timeliness of financial statements. I've been on this council a year and a half, and we go in so much detail. But as a user of financial statements, what strikes me sometimes is that they come out so late, and the disclosure around it is almost non-existent. You might get a little statement on Emma saying, we're past our 6 months, which might be a covenant in the legal documents. But besides that, as a user, you're just sitting there and you're turning to unaudited, maybe financial statements, budgets, other things you can get your hands on. And that kind of diminishes to me like the value of all these conversations we have here. So just wanted to raise that.
Any other areas of feedback? Joel?
I'd like to, I guess, further comment on Carl's timeliness issue. There's been a lot of kind of talk about financial reporting, the time for financial reporting, the time for auditing. There's a number of state legislatures that are looking at ways to improve that. Certainly, if you kind of hear about some of those, in particular in our that we care about is somehow moving away from using GAAP as some version of that. We'd love to hear about it because we continue to believe GAAP is the gold standard and is what government should use to report. But I think that there is a lot of things kind of with technology, with some single audits going away. I think there's going to be, and we've already seen some improvement in the timeliness at a national scale the last year or two. So I think we're going to start seeing some of these improvements. So I hope that people aren't over kind of reacting to that. But I think it's the other part, inevitably in these conversations, when I have with legislatures, et cetera, and they start talking about, there aren't enough auditors or whatever the problem kind of root cause is, I take them back to the report, the joint report that NASAC and AICPA did on public sector challenges for resources. And what that report, which I think is really valuable, showed was that it's just not, accounting and financial reporting isn't valued by the public sector in the way the private sector values accounting and financial reporting. And until we have more people like Carl kind of communicating the value of GAAP financial reporting that is audited and how and why that's important so that governments understand the value proposition broadly, I think we're always going to struggle, because what I see people doing is trying to solve a problem where that's the problem, but they're not solving that part of the problem. They're solving that in a different way. There are some governments trying to find a way to solve that problem and create extra value propositions to encourage and or require timely financial reporting. But we totally agree timeliness is important. To the extent we can help that, right, through reductions of requirements where we improve the report again by reductions, we'd love to be able to do that too. But at the same time, we need that value proposition to be communicated to governments who are thinking about these kinds of things. So I appreciate you kind of talking about timely financial reporting, GAAP, and the things we talk about here are important.
Thank you, Joel. Any other items for discussion on emerging issues? Bill?
Bill Blunt, NASBA. Yeah, to follow up on that, Joel, I reached out via email to a large constituency. One of the major feedbacks I got was the idea at the local government, and I'm sure Dean will chime in after this comment, is that the pressures put on by the standards being put out on staff to deal with that with their regular daily jobs, and the lack of resources available to do that accounting and financial reporting is still a major stress point. And so I think that just continues, and it's a tough road. We see it regularly. I think the other thing that makes it complex is there's, like on the pension side, you have to go outside the government to get a lot of this information to bring into the financial statements and to coordinate that to make that timely reporting as well. So there's a lot of moving parts there. So we've seen, speaking about a recent conference, we see in the state of Florida anyway, there's been some improvement in the filing. We currently have a 9-month deadline. I believe Texas has a 6-month deadline by state statute. So they are seeing some progress in that 6-month window, but I'm sure to the financial folks, 6 months is a long time, if I had to guess from their perspective. So the other issue that came up was talking about mitigation for environmental issues, sea level rising, if you will, and how would you account for that? How governments evaluate or address, dollars that they put into those activities for mitigation.
Bob?
Bob Scott, GFOA. At my prior city, we routinely issued within 120 days of year end, which was the MSRB recommendation. And I actually had a GASB board member who had formerly been a municipal securities investor. When I introduced myself as being from Carrollton, he goes, "Oh, I like Carrollton paper." And, and of course, it puffs you up. And obviously, I felt like there was a lot of value to issuing as timely as I possibly could and made that effort. I was also fortunate enough to be at a city that had the resources and whose council gave us the resources. Now, at my current city, I am trying to get past the second meeting in March, which is right at 6 months. And we just issued at the first meeting in March, and I've set a goal for staff for last meeting in February, so we're trying to gradually move it up. But I will say there is a definite relationship between complexity and timeliness. There just is. And the more complex things are, and as Bill mentioned, the more you have to go outside the entity. Capital projects have been one of my biggest delays, and a lot of it is because we're rapidly growing, and the developer contributions, we don't always get the records from the developers of assets that have been finalized and accepted by the city until well after year end, and it's terribly material. So that delays us. So those are some of the challenges we deal with.
All right. Thank you, everyone, for the discussion. With that, let's take a 15-minute break. It is 10 o'clock, and so we will reconvene at 10:15. All right, everyone. So we are going to jump back into our agenda, and the next item we have is the Revenue and Expense Recognition Project, and I will turn it over to Diane Ray.
Thank you, Rob. For the Revenue and Expense Recognition Project, we are continuing to work on measurement. And one of the more notable tentative decisions the board has reached for measurement is that the objective of an allocation of the total binding arrangement amount is to allocate consideration in a manner that provides a faithful representation of the economic activity in each transaction. You all got that, right? Also, the board has tentatively decided that variable consideration results in measurement uncertainty. And so governments should develop estimates that are reflective of the 6 qualitative characteristics of financial information from Concept Statement 1. So as we continue this discussion about measurement, at the May board meeting, we continued to deliberate on the allocation of consideration, and we're going to ask you to weigh in on that today. In addition, we also ask that you provide your thoughts on methods to develop estimates of variable consideration. We will be discussing that at the board meeting tomorrow, so it's really important to get your thoughts and feedback. It's so helpful, and we really appreciate it. And at this point, I'm going to turn it over to staff.
Thank you, Diane, for that introduction. And so with that, I'm just going to have Kara get started.
All right, we're going to start today's discussion with the allocation of consideration component of measurement. And at its March 2026 meeting, the GASAC did provide initial feedback on the allocation of consideration. And that discussion began with the general principle of allocation, which is illustrated here on the slide. This slide represents the overall structure of allocation within the measurement component of the project. And under this structure, a government would first identify all components of consideration included in a binding arrangement. And those components could include items such as fixed consideration and variable consideration, specifically items such as discounts, bonuses, and contingent consideration. Those components would then be totaled to determine or arrive at what we call the total binding arrangement amount. And then once that total binding arrangement amount is established, that amount would first be allocated to each transaction within that binding arrangement if there is more than one transaction. And then allocation would go potentially a bit further to each recognition unit of account. So for category A transactions, this means that we would allocate from the transaction to each performance obligation. And then for category B transactions, this may mean that we would have to allocate further if the recognition unit of account is more disaggregated than at the transaction level. And as Diane first introduced, the GASAC also provided feedback at its March meeting regarding the objectives for allocating consideration. And that was to allocate the total binding arrangement amount to each transaction. You would allocate in a manner that provides a faithful representation of the economic activities in each transaction. And then the objective for allocating a total category A transaction to each performance obligation would be to allocate an amount that reflects what the seller is entitled to for transferring control of distinct goods or services to the customer. Now, for today's, what we're looking to gain from GASAC today is the board to discuss the board's tentative decisions regarding the overall general methodology for allocating consideration. So at its May meeting, the board did deliberate and make tentative decisions regarding the methods for allocation. And then the first thing I would like to note is that there is existing literature regarding allocation of consideration. First, in Statement 87, which is our standard on leases, there is guidance there regarding the allocation of lease and non-lease transactions within a lease contract. And that guidance provides that governments would use prices that are included in the contract, provided they do not appear to be unreasonable based on the terms of the contract. If prices are not observable or appear to be unreasonable, then governments would use their best estimate to make that allocation. And then lastly, if it's not practicable to determine an estimate, then governments could treat the lease and non-lease transactions as a single lease unit. There's also existing literature in FASB Topic 606 regarding allocation, and this is allocating the transaction price to each performance obligation. And under that guidance, it establishes that entities would use observable standalone prices to allocate to each performance obligation. And if the standalone selling prices are not directly observable, then entities would estimate that standalone selling price to allocate. So in the context of this project, first looking at allocation from the total binding arrangement amount to each transaction, the board has tentatively decided that governments would use observable amounts included in the binding arrangement, provided they do not appear to be unreasonable. The board believes that the binding arrangement can provide relevant observable evidence of the economic activity in each transaction, and using observable amounts in the binding arrangement as a basis for allocation helps align the allocation of consideration with the same economic activity that underlies the identification and categorization of transactions. Then, if the binding arrangement does not specify observable amounts for individual transactions, or those amounts appear to be unreasonable, using an allocation methodology based on estimates would be necessary. So that is, governments would use a method to estimate the relative amount of consideration attributable to each transaction. The board did not require a single method for how to estimate the allocation of consideration. Governments enter into a wide variety of binding arrangements, and they may have access to different types of information. So in some circumstances, cost information may be readily available and provide a reasonable basis for determining how to allocate, while in other circumstances, observable pricing for similar goods or services may be more applicable. So as a result, the board tentatively decided that the principle would be to use a method that maximizes the use of observable information. To illustrate how this allocation method would be applied in practice, we have this example of a fundraising golf tournament in which a university conducts an annual fundraiser to benefit its athletics department, and a participant would pay about a $5,000 payment to participate in the tournament. In this example, the binding arrangement is the agreement between that participant and the university determines that this binding arrangement has two transactions. One, a Category A performance obligation for the provision of the services related to providing the golf outing, and then also a Category B transaction, which is the voluntary donation. So in this example, the binding arrangement doesn't have observable amounts, so the university can estimate how to allocate that $5,000 to each transaction. There's one option, number one, which is based on cost, where they could allocate the Category A amount based on costs of providing the golf outing, and then allocate the remainder to Category B donation. Or another option would be to use a standalone selling price, which would allocate the Category A amount to amounts charged for similar golf outings at that golf course. and then allocate the remainder to the Category B donation. Based on the board's tentative decisions, the government would again select that option that maximizes their use of observable information. So the example we just provided demonstrates how a binding arrangement may have a Category A performance obligation transaction and a Category B donation. And in addition to asking for GASAC feedback about the board's tentative decisions regarding the methodology for allocation, we also want to obtain your feedback on some practical examples that you might see out there. So that is, what other examples have you maybe seen in practice in which there's one binding arrangement that's giving rise to more than one transaction? So this could be a Category A transaction with a Category B, similar to the example we provided, or some other type of Category B, or if you've seen binding arrangements that maybe contain multiple Category B transactions. And on the slide there, we provided you with some examples of different types of Category B transactions. So with that, I'm going to pose the first three discussion questions together because I think they're all interrelated. So question one, do you agree with the board's tentative decision that to allocate consideration from the total binding arrangement amount to each transaction within the binding arrangement, a government should use observable amounts relative to each transaction in the binding arrangement, as long as the amounts do not appear to be unreasonable based on the terms of the binding arrangement and professional judgment, and why? Question two, do you agree with the board's tentative decision that if observable amounts appear to be unreasonable or there are no observable amounts in the binding arrangement, then a government should select an allocation methodology based on estimation to determine the relative amount of consideration attributable to each transaction that maximizes the use of observable information, and why? And question three, what examples have you seen in practice in which a binding arrangement gives rise to more than one transaction?
So, Kara, a quick question for clarification. As they're answering, is it just answer all three, or is it just, do you have a preference?
I think it's fine to answer all three.
Thank you. Feedback for Kara? Michelle?
Michelle Waterworth, AICPA. On the first one and the second one, really, we agree with both. On the first, it seems logical. It definitely, we believe, honors the agreement, but yet allows for professional judgment when the amounts appear unreasonable. And to us, it reinforces that measurement should represent the underlying economic substance faithfully, which obviously we support. On the second one, again, we agree. We think the use of professional judgment provides flexibility, and maximizing the use of observable information seems like it would result in a best estimate, which of course we absolutely support. And then on the third question, in terms of example transactions, certainly can think of a lot of examples where a binding arrangement gives rise to multiple Category A transactions. But had to think a little bit about situations where there would be an A transaction and a Category B transaction. And one thing that I came up with was a court payment. So a court payment may include a punitive fine, which would be Category B, but it also may include administrative or processing fees, which probably would be a Category A transaction.
Scott?
Scott Deviney, AGA. Questions 1 and 2, we agree. Makes sense. Seems aligned with GASB 87. Question 3 was harder. Easier to think of like examples on the expense side, I think, or leases. We had thought about combined utility bills or car tab fees or park passes where there's a donation component. But then we kind of thought maybe those are separate binding arrangements. They're definitely, it's very easy to separate those things. So I think the only thing we have to contribute would be like intergovernmental contracts for shared services where there's fixed and variable components. So think like, you have a shared jail or police services or 911 or water treatment plants where the fixed components like a flat monthly amount that everyone's contributing. And then there would be a variable component based on usage or activity. I don't know if this is a good example, but I'll pass it along. A grant agreement where the transactions are reimbursement requests, but or maybe that's not. I don't know. Thank you.
Samuel?
There it went. Okay. Sam Rippin, ASBO International. I'll take them in order. I do agree. To me, this speaks to best effort, every effort. Where you have information, you should use it. When you don't, you piece together the best information that you have to allocate consideration. Again, that ties to agreement or to question number 2 for using the golf, and then the example that was brought forward, which was the golf tournament. I happen to be a treasurer for our local Lions Club. Granted, that's not government, but their only fundraiser is a golf tournament. And you could see one of 2 ways. Clearly we make money on the golf tournament itself. A golfer will pay, in this case, let's say $185. And the cost to the club is probably about $125. And we know what that is. And so to me, if you know what the cost is to the organization, as opposed to what other events would charge, I would goes to 1 and 2. If you know what to allocate, and this also has tax ramifications for the person paying the $185, how much of that is tax deductible? And so if it costs $125 and they pay $185, $60 is a donation, $125 is for services rendered. So I would, I guess as strong as I can be, say I would use information that for the organization itself rather than market value.
Dean?
Dean Mead, NFMA. So for question 1, we agree. We always prefer that the numbers we're looking at are based upon actual prices that are available as an alternative to estimation. But in the absence of those, with respect to number 2, we agree with what's proposed there, with the caveat that we'd want to know what they decided to do, whatever choices they make about how they're going to come up with this amounts in the absence of observable information. We need to know what that is so we can, as with any other estimate, make our own judgment about the substance of what they've done and whether we agree with it. With respect to number 3, I think similar to the golf tournament example, public cultural institutions, will sell memberships, and typically, as Sam was saying in his example, they typically, for tax purposes, specify the portion that is the cost of what they're giving the member in return, the free, some estimate of what the value of the free entry throughout the year is for the member or member and family, depending upon the level at which they contribute, as well as discounts or other things that they get as members, and then the remainder of that is a donation. So I think translating that into our world here, that there's a portion where they're selling a good or service to the members, and then everything above and beyond that would be considered a Category B transaction as a donation.
Tyler?
Tyler Montana Prescott, NACO. I want to echo a lot of what's been said already, especially like Michelle said. Basically, it's important, I believe, for us to be able to use professional judgment at the government level to basically make these estimations whenever there's no basically clear way of allocating. Certainly, they need to be accurate and reasonable, just as long as they say what those methods are for coming up with that professional judgment, I think. As the question as multiple transactions in a binding arrangement, we have a lot of those where I come from, especially that have multiple Category B transactions. For example, if you have a special assessment that's unpaid on your property, basically we will lump it in with your property tax, not let you pay it. So you have to pay both of those at the same time. Or even with car tags, basically, if you want a specialized plate like to support, spay neuter, like I have a vehicle with a tag on it, you pay basically the tag fee plus there's a $50 donation to get the car tag. So, and especially in local government, we see a lot of them where there's, multiple transactions at the same time.
David?
David Goldman, National League of Cities. So, yeah, we would agree with questions 1 and 2. The elected officials, they value transparency and simplicity. So just following the observable amounts for each transaction would definitely help things out. As far as number 2 goes, where it's not as clear, it's good to use our professional judgment to try to figure out the best allocation methodology, but to a point, because our elected officials don't want us spending weeks and weeks trying to figure out 1 or 2 transactions. They'd like it to be as simplistic as efficient as possible. So it's good that we're be allowed to use our professional judgment in number 2. And as far as number 3 goes, I like the example that was used in the documentation about the golf. Perhaps another example might be like a developer's agreement, where you have packages that include like building permit, regulatory fees, the Category B stuff, along with specific fees in there for the city to perform like utility connections and things like that, which would be Category A. So just another example to think about. Thank you.
Then Rob Hamilton, NASAC, and in our committee, we were supportive of questions 1 and 2. I thought the arguments as they were laid out in both the slides and the paper, persuasively kind of aligned with our own thinking. So we were in agreement with that. The example that came to my mind in terms of for number 3, in Oregon, we have liquor sales that are controlled by the state, where we have liquor taxes plus the liquor sales. So that's the one that was kind of closest that might meet the definition for the Category A, Category B within the same binding arrangement. The only other one, and it's kind of goes along the line of the golf tournament that we had talked about in our subcommittee, was maybe some football tickets for some colleges and universities where there's the donation and then the price of the ticket as well. Seeing no other discussion, Linda.
Hi, American Accounting Association. We absolutely support the questions 1 and 2, agree. For examples, universities, major universities, research projects, and lots of examples I could provide. For example, Public University has a partnership with an outside agency. That agency could purchase specialized testing services on behalf of the university. And then that university could also have $1 million grant to support the infrastructure related to those projects. So there's lots of complex college and university application to the revenue recognition. Thank you.
Bill?
Bill Blend, NASBA. Again, agree with both 1 and 2, with the cautionary tale that we look for consistency in reporting, yet oftentimes these transactions are evaluated by people that may or may not have the appropriate skill set. So I do worry that at some point in the future, as the standard gets implemented, the consistency, how different governments handle similar transactions. And there was some really good examples provided, but I didn't have anything additional there.
All right. Back to you, Kara.
Thank you for your feedback, and I do really appreciate the examples that you all provided. All right, now we're going to shift to the methodology for allocation of a Category A transaction to each performance obligation. And the board made a tentative decision or the approach for this allocation really mirrors the earlier framework, in which governments would use observable amounts included in the binding arrangement, provided they're not unreasonable, based on the terms of the binding arrangement. And then if they are unreasonable or they're not observable, then they would use an allocation methodology based on estimates that maximizes the use of observable information. So this approach keeps the methodology consistent from both levels of allocation, but this also does continue to achieve the objective of allocating a Category A transaction to each performance obligation. So again, we have some examples to walk through how governments would apply this methodology. So the first example I have here is an example of a revenue transaction in which a government provides 3 services to a private university over the course of 1 year. So there's a binding arrangement in which this government will provide garbage removal, street sweeping services, and snow plowing. And in this first scenario, all 3 of those services are specifically stated in the binding arrangement. So in this case, the government would use those amounts specified in the binding arrangement to allocate to each one of those performance obligations. Changing the scenario slightly, so instead of the amount specified for each of those services in the binding arrangement instead just stipulates that the total contract price, so to say, is $300,000. So in this scenario, then the government uses relative historical costs of providing such services to the university in the past. So in this example, they estimate the garbage removal to cost about $126,000, street sweeping $84,000, and snow plowing $70,000. And then they would allocate those proportions or they would determine those proportions and then allocate that respectively to each distinct service. And then in the third scenario, the binding arrangement breaks out the amounts 2 ways. So one, it designates $150,000 specifically for the garbage removal, and then also $150,000 for the street sweeping and snow plowing. And this potentially could be example, maybe if the services are conducted by different departments within the government. So the highway department does street sweeping and snow plowing, or a Department of Public Works maybe does the work for the garbage removal. So in this case, the government could use the $150,000 because that's observable in the binding arrangement and appears reasonable. And then they would have to estimate that allocation for the other 2 distinct services. So in this case, this is more of a mixed allocation approach, but still maximizing the use of observable information. And then I have an example of an expense scenario where a government enters into a binding arrangement with a vendor to purchase some supplies, road salt and sand. In this example here, the binding arrangement does specify the amounts because it provides how many tons of salt and sand the government will purchase, as well as the price per ton. So in this example, again, the amounts are observable within the binding arrangement, and the government can allocate that proportionately. And then in the second example, the binding arrangement just specifies a total amount for those 2 distinct goods. And then the government can decide maybe there's an observable price listing from the vendor, right? So then they could estimate how to allocate that $120,000 based on that price listing because it's observable. So with that, I'm going to pose discussion questions 4 and 5. And that is, do you agree with the board's tentative decisions that for Category A transactions, to allocate consideration from the total transaction amount to each performance obligation, A government should use observable amounts relative to each performance obligation in the binding arrangement as long as the amounts do not appear to be unreasonable based on the terms of the binding arrangement and professional judgment, and why. And number 5, do you agree with the board's tentative decision that if the observable amounts appear to be unreasonable or there are no observable amounts in the binding arrangement, then a government should select an allocation methodology based on estimation to determine the relative amount of consideration attributable to each performance obligation that maximizes the use of observable information, and why?
Feedback for Kara? Dean?
Dean Mead, NFMA. Similar to questions 1 and 2, we don't have any issue with what's proposed here. It makes sense. But I was wondering if you could just step back for a second and say something, can place this in context as to why this needs to be done. Why does the government need to go through this process, in terms of doing their accounting and their financial reporting? So the reason why I ask this is I look at this example, which obviously you're simple on purpose, but why couldn't that government providing those 3 types of service just recognize $300,000 in maintenance revenue? What do they accomplish by breaking it down into these 3 services? If as things probably are going to turn out in their financial statements, those aren't going to be separate revenue categories that they're displaying on the face of the financial statements.
Sure. I think that you have to think about this in the context of, and we haven't talked too much about so far with the GASAC, variable consideration. And so if you have a transaction like that and there's, say, a discount or there's some type of variable consideration included, and you have to then, the next step will be also adding that variable piece to those 2 things. It's going to be important, the relative proportion of the amounts when you go to allocate pieces of variable consideration. And then as those goes to those recognition units of account. And so you maybe recognize things at different points in time, depending on when the transfer of control happens. And so then those amounts need to be, inclusive of all of the 2 types of consideration, including variable, which will be usually at that same, relative proportion as the original allocation of the fixed amount. Does that make sense?
Scott?
Scott Deviney, AGA, we agree.
Michelle?
Michelle Waterworth, AICPA. We also agree with these 2 questions.
Stephen?
Stephen Stewart, Governmental Research Association. We agree with the staff's recommendations on both. The board's tentative decisions on both. It's consistent with, as others have mentioned, what was proposed for questions 1 and 2, which the overall picture makes sense. It's an interesting concept. I wanted to mention that economic development agreements are perhaps another area where this might appear. It might be important. For example, a public body may enter into a lease with a private developer and provide also an upfront cash payment and perhaps an ongoing tax rebate. So those are multiple components, different obligations. So this is a helpful way to think about the breakdown at the binding arrangement level and the transaction and the performance obligation level.
Tyler?
Tyler Montana Prescott, NACO. I would say that we agree with the board's tentative decision on both 4 and 5. And just following up with Dean's comment, he was talking about when would this be useful, like, when you have one contract. For example, in my county where we budget basically as the revenue commissioner, I'm the assessor and the collector. And under statute, part of the assessor's budget is reimbursed pro rata from everybody that we assess for, but the collector's budget is not. So I'm on one computer system for both. So I have to make the professional judgment every time that I'm doing something, buying a software or something, what percentage, of the software is being used for which function. So that way we could allocate it out for reimbursement. So even though it's one expense, that's just one of many examples where we have to use our professional judgment to basically divvy it out, whether it's hours used on the system or something like that. So it is important to break it down sometimes.
Christine?
Christine Brock, ICMA, and the rationale is sound on both of these, and I think it makes sense how it's written. I would say just in practicality that in local governments, when we have agreements for service, we work hard not to have arrangements that have implicit subsidies in providing services, and so typically these agreements are based on as close to actual costs as can be done, and they're not necessarily typically flat fees because, of course, labor rates change. Costs of for example, costs of buying salt will change over time. So and also the entities in which those arrangements are with, they want to see what the costs are. They want to see how much the supplies cost. They want to see how much the labor costs. So they want to see how many hours it took to provide that service. So there's not as much in these examples, which they're simplistic for good reasons. They're typically, the service arrangements want to have the backup detail, as we say, to make those, which is probably, as you say, in category A, you've got the detail to make the good judgments.
And then Rob Hamilton for GASAC, we also agreed. As I was thinking about these scenarios, I think they're, for a number of times, governments probably won't go through the rigor of this, but if they need to, it gives them a framework to follow, which I think is really helpful. So we're in support. Back to you, Kara.
Thanks, Rob. So lastly, the final topic on allocation for today is on timing. And the board believes that the methodology used to allocate consideration is intended to provide a faithful representation of the economic activity in the transaction as evidenced by the binding arrangement at its inception. So therefore, the board has tentatively decided that the allocation methodology is determined at the inception of the binding arrangement and it's not subject to reassessment. So that is, once an allocation methodology is applied, subsequent changes in information used to estimate the relative amounts of consideration to allocate would not need, they would not have to change how the consideration is allocated, because doing so would potentially alter the depiction of that original agreement. So as a result, updating the allocation for such changes would result in allocation that no longer reflects the provisions of the binding arrangement as entered into. So the last discussion question is, do you agree with the board's tentative decision that the allocation methodology should be determined at the inception of the binding arrangement, and once the allocation methodology is established, it should not be reassessed at each reporting period, and why?
Sophia?
Thank you. Sophia DeCaro, NGA. Agree that it should not be reassessed. Just as I was thinking about this question, thinking about multiple funding sources and timing of different funding sources to cover that cost. And then also just it would create a lot of volatility in budgeting and setting your budgets. So for those two reasons, I agree.
Scott?
Scott Deviney, AGA. We agree, but would add that if there's a significant change to the binding arrangement, we feel like it should trigger reassessment similar to leases. So just suggest the board consider a parallel similar requirement there. And then, if the allocation methodology is changed, we'd expect this to be considered a change in accounting principle subject to disclosure if significant. Thank you.
Harriet?
Harriet Richardson, Association of Local Government Auditors. I basically agree with what Scott just said, that most of the time, yes, I would agree with this. But if if information comes available that would affect that allocation in a material way in relation to that binding agreement, then you would want to reassess it. But that should not be at each reporting period. It would be kind of a one-time thing, most likely.
Michelle.
Michelle Waterworth, AICPA. Agree with the caveat, similar to Harriet's response. In principle, in theory, we agree management should not be reassessing this every reporting period. But let's say you have unobservable inputs and you're using your best methodology in year 1, and in year 5, some new information comes to light that basically compels you to say, really, it was today, based on what I know, it's really not a best estimate. I think there should be a way to update that estimate.
Bill?
Bill Blenton, NASBA. I concur with that. I mean, I almost think that's a disagreement. So I guess I'll go on the record and say disagree because of that purpose. That as an example, interlocal government might get involved in, they'll get in a contract for multiple services and over time realize that they're heavily, however I want to say that, applying it to one portion of the agreement versus another. They don't want to redo the agreement per se, so that allow them that flexibility.
Bob?
Bob Scott, GFOA. I actually put my 10 up before Scott, not knowing that I was going to agree with Scott. So materiality, and again, it's not necessarily an annual thing. It's when the binding arrangement substantially and materially changes, you have to look and say, is it still representationally faithful for the new arrangements?
Abel?
Abel Palacios, ACI. I agree with the comments made on the reasonableness and effectiveness, but I have a question for the group. Does this application apply to capital projects? Because the examples that I'm thinking of from an airport perspective, we do have some variable pricing from capital infrastructure where our construction contractors are given incentives for speeding up completion of projects and, to the tunes of millions of dollars. And it's amazing what can get accomplished when you give them some financial incentive. So that being said, my question is, this guidance apply to capital infrastructure as well, or is this strictly revenue and expense side?
Two things I would say is that the board hasn't discussed contract modifications yet, or binding arrangement modifications. So we're really not talking about a binding arrangement, being modified at some point. We're talking about the original binding arrangement. And we're also talking about the fixed portion of it, to your point about incentives, which would be a variable portion of a binding arrangement. That's really not what we've gotten into yet. We're talking about the fixed portion at this point.
Thank you, Pam. Dean?
Dean Mead, NFMA. I'm going to be infuriating because I'm going to say one thing and then immediately say the other. So this proposal makes sense to me, as in, they determine based upon the transaction, and what's involved in it, how they're going to allocate the consideration. And I certainly don't want governments to be required to go back and do this. That totally with that. But, listening to the comments that were made about the possibility that something could happen in the transaction, some change could take place that would render that decision, make the choice about allocation methodology no longer appropriate. I'm having trouble thinking of what the example would be that, where the allocation method would still be valid, it'd be just fine, but the numbers that go into it might be different The allocation might change, but the methodology is the same. So I'm open to the idea that there might be some instance in which the transaction is changed in a manner that the choice they made about methodology is no longer appropriate. I just can't come up with an example, and of what that would be, that would change the transaction so dramatically that whatever decision they made about how to allocate the pieces of it, would be considered inappropriate going forward. And I also did want to just confirm, we're talking about this on a transaction by transaction basis, right? This is not, this is how we approach this type of transaction. This is at the inception of this particular transaction, we made this decision, right? Okay. Thank you.
So Rob Hamilton, NASAC, our group agreed. They were supportive of the board's tentative decisions on this front. Back to you, Kara.
All right, so we're going to move on to the next topic for you today for your discussion, and that is methods to develop estimates of variable consideration. At this meeting, the board will consider whether specific methods for developing estimates of variable consideration should be proposed in the project. And so existing GASB literature provides different approaches to developing estimates, such as probability-weighted techniques and the selection of a most representational amount within a range of possible outcomes. FASB Topic 606 addresses methods to develop estimates of variable consideration and requires the use of either the expected value method, that is a probability-weighted amount, or the most likely amount method, depending on which method the entity expects to better predict the amount of consideration to which it will be entitled. The board will consider 3 options related to methods to develop estimates of variable consideration. Option A would identify the probability-weighted amount and most likely amount as the only methods permitted to develop estimates of variable consideration. Option B would identify the probability-weighted amount and the most likely amount as examples of methods that may be relied upon to develop estimates of variable consideration. However, a government would not be precluded from using another method. And option C would not identify any specific methods. Under all 3 options, the broad objective of the board tentatively decided at its March 2025 meeting would apply. That is, if a government would develop estimates that are, to the extent practicable, reflective of the 6 qualitative characteristics of financial information included in Concept Statement 1. The project staff is recommending to the board option B because we believe that identifying the probability-weighted amount and most likely amount as examples of estimation methods that would result in an enhanced opportunity for comparability in practice, while also allowing for flexibility across the broad range of Category A and Category B transactions in the scope of the project. So we provided, and you can see in the next 2 slides, we'll go through examples of the probability-weighted amount and the most likely amount. In the first example, a university receives tuition payments from students prior to the start of the semester. Some of those students may withdraw and receive a refund according to the university's refund policies. For example, if a student withdraws by the end of the first week, the university is obligated to provide the student with a 100% refund. The refund amount then declines each week until the university is no longer obligated to provide a refund after the 4th week. Because the university enters into a large number of tuition binding arrangements with substantially similar terms, it estimates a probability-weighted amount across the portfolio of tuition binding arrangements, rather than developing separate estimates for each binding arrangement for each individual student. As shown on the slide, the university estimates that it is probable that some percentage of students will withdraw by week 1, week 2, etc., and develops an estimate of the variable consideration, which is an estimate of the amount it will be obligated to refund based on a probability-weighted amount. Slide 20 shows an example of a performance bonus. In this example, a local government enters into a construction contract that includes the possibility of a $500,000 performance bonus that is dependent on achievement of a specified quality rating associated with the contract, with the contractor's work. If the government determines that it is probable that the performance bonus will be paid, the government could use the most likely amount method and would likely identify $500,000 as the most likely amount, given that the outcome is binary, either $0 or $500,000, and the outcome is assessed to be probable. So that brings us to discussion question number 7. Do you agree with the project staff's proposal that the probability weighted amount and the most likely amount should be identified as examples of methods that may be relied upon to develop estimates of variable consideration, while permitting a government to use another method provided it is reflective of the 6 qualitative characteristics in concept statement 1, and why?
Feedback for Pam? Sam?
It's funny, when I, before the examples were brought out, I would have said, well, I still say option B. In my mind, if you're having governments go through the effort of doing a probability weighted amount and the most likely, but then you're going to say they can do whatever they want anyway. Doesn't make sense to me, and C certainly didn't make sense to me. If it were me, I would go to A. I think, you have 2 solid methods to get at the calculation, and at that point, as the examples show here, work went into it. A fair bit of work probably went into it. With the university example, past history probably went into it. They didn't just pull these numbers out of the air. And so I guess I would support option A for those reasons.
Anita?
Anita Kovacs, National Association of College and University Business Officers. Since the example was about a university, I just want to indicate that I am in favor of supporting the probability and allowing you can use the best probability, and we do know what to expect. But I would couch the example about universities and colleges not as tuition refunds, but as tuition, because we all know what happens with our tuition, and refunds are just part of it. And depending upon your situation, whether you're a university or whether you're a community college, you have 2 different paradigms going on, and it needs to apply to both a university and a community college. With a community college, one of the big differences is it is open enrollment. We have people up until the day of drop ad that we are still enrolling in classes. And so a lot of the precepts in that example, while they are very clear and simplistic, they really don't apply to the community college model. But we all know historically what happens to our tuition and our refunds. So as long as we can use the probability weighted way, I wouldn't get too detailed on that example. That would be my feedback.
Dean?
Dean Mead, NFMA. I think my preference would be for A. Those 2 options there, I think, are, either one of them would be, an acceptable way to come up with the estimates. But I hear flexibility and I immediately think diminished comparability. And if these are acceptable ways of coming up with the estimates, my preference would be that governments pick one of the two of them and not open this up to them essentially being able to pick whatever they want. And also just putting back my my firm hat, I don't think any of my fellow partners in the attest area, want to be in the position of having to determine what's an acceptable way of doing this. I think that their preference would be, if these if these approaches are okay, that say that, pick one of these and stick with it, and not come up with a separate approach on your own.
Scott?
Scott Deviney, AGA. Sorry, I'll throw out a different view. To reiterate our position from the last meeting, our group just believes that RER decisions should be consistent with leases and SPIDAs and PPPs. And so in this case, we don't believe variable consideration should be recognized until it occurs, other than situations where it's fixed in substance or variable based on index or rate, just like leases and SPIDAs and PPPs. Be happy to talk about that offline, I guess. But the other thing I wanted to mention was just I don't understand the tuition revenue example as an example of variable consideration. To me, it's about an estimate of an offset to revenues, kind of like allowance for doubtful accounts. I don't think it's variable consideration. Like conceptually, this isn't a binding arrangement or a transaction that has a variable amount of consideration. It's a binding arrangement or transaction that is canceled. So in any case, I think maybe a better example would be like a public golf course, and where there's a management agreement that is based on the amount of sales or something else, which I guess goes back to the reason why we think it should be consistent, because golf courses could be in the form of a lease or a PPP, or it could be a vendor transaction, and it'd be sad if it was a different recognition depending on the form of the transaction. Thanks.
Sophia?
Sophia, NGA. I actually agreed with option B and with what the project staff's proposing, just because you're probably going to end up with A as a default, because you're kind of leading the person a bit, and so you'll likely end up with the probability weighted amount method or the most likely. But it also provides a little bit of room and flexibility for some unique case that we're not thinking of, which can be frustrating when you're trying to figure out how to do it and may not fall into, those examples. So I like that you're providing flexibility, but also kind of leading the person with some direction and expectations. So you're likely going to end up with A. And I think that helps newer professionals trying to figure things out as well. Thanks.
Linda?
Hi, Linda Ragland, American Accounting Association. Representing the user groups in intermediate accounting, we already teach the probability weighted and most likely. Our students get it. It's pretty straightforward. The only real question mark that I had in reading this is the flexibility. And this is kind of piggybacking on a comment Dean made. If you introduce that flexibility, I'm not quite sure what kind of noise, and the user groups do understand weighted probability and most likely, but adding that additional piece, I'm not sure how that will be useful unless there's full disclosure on how they're estimating. Thank you.
Michelle?
Michelle Waterworth, AICPA. We did support option B and agreed with the staff recommendation. I think Sophia articulated it well. I think if you offer a probability weighted amount and the most likely amount, 99% of the time, that's where you're going to end up with. But I don't think we should shy away from the ability to use professional judgment if you have a unique scenario where those two options just don't fit.
Darren?
Darren Tarleton, HFMA. Yeah, I agree with the staff proposal here for the reasons that were just articulated. I think given the examples or the guidelines is good. I like the consistency with topic 606 since we're dealing with BTAs in the healthcare industry, but also not hemming in entities in their approach when they're doing complex modeling, force themselves into a weighted probability approach versus just coming up with what they think is the right answer. But it's not a binary or 3 or 4 limited options that you might get in a most likely amount. So we are supportive of B.
Christine?
Christine Brock, ICMA, and well, I do agree with the rationale for option B. And the example that I was thinking about though was for Parks and Rec facilities, or if you have a conference center, an event facility, there are certainly cancellation provisions, and we have a good handle on what those cancellation provisions, how they're used, and those work well with the probability weighted. But then there are certainly in 2020 and 2021, we had a whole different scenario on what was canceled or what was moved and so. But those were conversations with our auditors. I mean, it wasn't just changing the method with a staff without having that conversation. Our auditor knew exactly why there was more cancellations and why perhaps the use looked very different than it had the year before or 2 years before that. So that was having the flexibility would maybe allow this to be something that lasts longer if in case something does come up. And hopefully that would always be something that you as staff would talk to your auditors about and explain why what had been your experience is not your experience right now.
Abel?
Abel Palacios, ACI. I'd also support the option B for the same reasons that Michelle and Sophia and Christine articulated as well.
Chris?
Chris Jumper, Bond Insurers. Option B provided the disclosure. I think that's important. If you're varying away from what you've done in the past, I think it needs to be disclosed.
All right. So Rob Hamilton, NASAC. We also supported option B, as was articulated by Sophia and Michelle and others. Agree that it's largely going to get for a lot of the comparability with the examples. I like that. I think it's really demonstrates a pathway forward for most, but then still providing the professional judgment for those that maybe have an unusual circumstance, thinking of the breadth of revenue and expense transactions that may be before us to give that flexibility. And in some cases, maybe a more simplified approach. So supportive of it. All right, back to you, Pam.
Thank you. The board will also discuss this week certain application issues associated with developing estimates of variable consideration. As I mentioned, the project staff believes that as the board has tentatively decided, a government would use professional judgment to develop estimates that are reflective of the 6 qualitative characteristics of financial information identified in Concept Statement 1. Additionally, as shown in the tuition refund example, the project staff believes that in its application of professional judgment to develop estimates of variable consideration for measurement purposes, a government should be permitted to apply a portfolio approach. That is to develop estimates at a more aggregated level than the recognition unit of account. We also believe that once a government selects an estimation method for a particular type of variable consideration, the government would apply that method consistently for that type of variable consideration, both within the binding arrangement and across binding arrangements with similar characteristics, while also being permitted to apply different estimation methods to different types of variable consideration. Finally, the project staff believes that the method for developing estimates of variable consideration be selected when the variable consideration is included in the estimation of the total binding arrangement amount. Going back to the performance bonus example on the prior slide, if the government assessed that it was not probable that it would be obligated to pay the performance bonus would not be included in the estimation of the total binding arrangement amount, and therefore an estimation method would not need to be selected by the government. So question number 8, do you agree with the project staff's proposal that in its application of professional judgment to develop estimates of variable consideration for measurement purposes, a government should be permitted to apply a portfolio approach, which is to develop estimates at a more aggregated level than the recognition unit of account, and why?
Feedback for Pam. Darren?
Yes, strongly support the staff proposal here. Again, healthcare, patient service revenue, effectively 100% of it is variable in one form or another, and it's totally impractical to not take a portfolio approach. You're looking at who the third-party payers are, the nature of the service, the site of care. These are all factors, the timing and amount of payments with settlements after the year end, oftentimes based on outside factors not known or directly relevant at the time of that the care is provided. So definitely think that portfolio approach is going to be used either way. So may as well bake it into the standard. Thanks.
Michelle?
Michelle Waterworth, AICPA, absolutely agree. We think the portfolio approach is more efficient when you have a large population of items. Not only a good example is tuition refunds, but utilities, property taxes. And we still think that you can end up with a very good estimate by using that portfolio approach.
Sophia?
Sophia DeCaro, NGA, agree. It was kind of torn because more information is always nice sometimes, but you always have to think of the highest and best use of time and what's practical. And so for those reasons, I agree.
Rob Hamilton, NASAC, we agreed. It's operable this way. I'm not sure it would be in any other format. So seeing no other comments. Oh, okay. I'm back to you, Pam.
Number 9, do you agree with the project staff's proposal that a government should apply its selected estimation method consistently for each type of variable consideration within a binding arrangement and across binding arrangements with similar characteristics, while permitting different estimation methods for different types of variable consideration within the same binding arrangement, and why?
Feedback? I'll say Rob Hamilton, NASAC. We were also supportive of this project staff recommendation. Again, I think it provides a structure that will enhance consistency while providing flexibility if it warrants it. Oh, Michelle. Thank you.
Michelle Waterworth, AICPA. We did have some hesitancy on this one. In theory, it sounds good, and certainly we want to promote consistency, but I'm a little bit worried in terms of how you define things. So for example, if you think about, when you define each type of variable consideration, for example, if you think about property tax refunds, I can envision a scenario where you'd want to apply different methodologies based on differences in the customer base. So for example, we've got large cities that have gaming systems, gaming entities that right now we're experiencing a high volume of refunds or property tax collection issues versus businesses versus homeowners. I think that dividing up that population in some instances is a really good way to get a good measurement of this variable consideration. So I think it all depends on how you define the type of variable consideration.
Other feedback? Not seeing any. Oh, Darren.
Yeah, this one, I think I agree with Michelle. I like it as I'm reading it that there's flexibility, but I think how we're defining this is what matters, and the interplay with the portfolio approach, if that's taken as well, but really trying to get to what is the best estimate of the variable consideration at the point in time based on the information you have. So I think being consistent when you have similar characteristics across the portfolio makes sense. If those change over time, as more information comes in, you may end up wanting to change the method that you're taking. So
David?
Yeah, David Goldman, National League of Cities. I agree with Darren. It's not required to use a portfolio approach, but it's permitted. And with local governments, there's large volumes of very low dollar value considerations, and using the portfolio approach would help with that. But it's not required. It could be done individually if a government wants to do it. And once a government decides, the type of way to apply something, it probably makes sense to do that across the board as well. So.
All right. One last look for tents. All right. Back to you, Pam.
And the last question we have for you, do you agree with the project staff's proposal that the method to estimate variable consideration should be selected when the variable consideration is first included in the estimate of the total binding arrangement amount, and why?
Feedback for Pam. Harriet?
Harriet Richardson, Association of Local Government Auditors. I agreed, but then with a caveat similar to the question number 6, if some better information comes along that would affect the allocation in a material way, that you should be able to make an adjustment. Thank you.
Other feedback? Christine?
Christine Brock, ICMA, and I concur with Harriet's comments. Thank you.
Sophia?
Sophia DeCaro, NGA. I also agree with the comments made by Harriet. Thanks.
Michelle?
Michelle Waterworth, AICPA. We also agree with the comments that have been made. Again, we do think that you should select a methodology when the agreement is entered into, but we do believe that there should be guidance to allow for changes in that estimation methodology if there are substantial changes in facts and circumstances.
Bill?
Bill Bland, NASBA, agree with the comments made.
All right. So Rob Hamilton, NASAC, we agreed with the project staff's proposal on this one. We like the idea of adding the variable consideration once, or deciding upon that once we were going to include it in. I think that made sense, and it precluded us from having to go through a step that wasn't warranted at that point. So we were supportive of the project staff in that case. All right, last call for comments. Okay, well, thank you, Pam. Thank you, Kara, for the materials. And it's 11:31, and so we are going to break for lunch. So we'll come back at about 12. Come back at 12:30, and we will reconvene our meeting. Thanks, everyone. All right, everyone. Hope you all had a good lunch, and looking forward to continuing the really good conversation that we had earlier today in the afternoon portion of our meeting. The next item on the agenda is going concern, uncertainties, and severe financial stress, and I will turn it over to Chris Knight to introduce the topic.
Good afternoon, everybody. Hey. So we're going to get started with going concern, uncertainty, and severe financial stress. Just to take a step back, you all may remember that the whole impetus of this project was really to look at how we define going concern and what it really means to government, and substantively what's actually really happening. Are they dissolving? Is it the severe financial stress causing the issue, what it is? And so that's why ultimately the project was broken into these two lenses to look through, right? It's the dissolution or the going concern or uncertainty as we formerly known it, and then the severe financial stress. And so we're going to spend some time talking about that severe financial stress piece. Maybe a little bit of a broken record, but as I said at our last meeting, let's just continue to not be driven by names or labels, but really look at the underlying substance and what we want to accomplish here, and let that drive our decisions. The names and the labels, we can always figure those out at later dates, and I know we're somewhat tied to them, and have this affection to them or believe that they might create some consistency across organizations. But for now, while we're looking at these things, if we can just look at the underlying, I think that'll help us move forward a lot. And then we could always figure the last piece out, that label at the very end. Team.
Thank you, Chris, and good afternoon, everyone. As Chris said, we have been continuing in our redeliberations from the preliminary views that we issued last year. And specifically, we are still working on the severe financial stress piece of the project. And even more specifically, we have been working through what is the disclosure requirement? That is, what governments are going to be required to make these certain disclosures. And so that's what we're going to be talking about today. So the tentative decision that the board has made for which governments will be required to make severe financial stress disclosures are those that are either insolvent as of the date the financial statements are available to be issued, those that are experiencing financial difficulties such that they are nearly insolvent as of the date the financial statements are available to be issued, and those that are probable of being insolvent within 12 months from the date the financial statements are available to be issued. And so if any one of those three criteria are met, that government would be required to make these disclosures. And visually, that is represented by the diagram. It's on page 2 of the paper. We talked about these various diagrams at our last meeting in March, with the different combinations of colored cars representing different situations. And this is the one that the board has tentatively decided to go with. So the first part of our discussion today will look at some of the details that go into this disclosure requirement. And the first of that is looking at some of the details for the governments that are experiencing financial difficulties, such that they are nearly insolvent. And there are two details related to this that we want to ask you all for your feedback on today. The first one is taking significant actions, or a need to take significant actions. So in the preliminary views, we proposed that a need to take certain actions was one category of example indicators that a government might be nearly insolvent, or near insolvency, as we called it in that document. And so we heard some feedback that maybe that should be elevated beyond just a type of example. Maybe it's even the definition of nearly insolvent. The board considered the options. They decided they did not want to define nearly insolvent based on taking actions or a need to take action, because that would exclude certain other governments that have not taken the actions or don't need to take the actions. They also did not want to elevate that one category of example indicators of taking actions above the other categories that were in the preliminary views. And so they have tentatively decided to keep taking actions as just part of the example indicators on par with the other types. The second detail related to nearly insolvent is for governments that regularly operate close to insolvency. And so some examples might be a special purpose component unit that relies on its primary government to give them the funds necessary to make a debt service payment, but that happens just before the payment is due. The money comes in, the money comes out. The rest of the time, they don't have much. Another example could be a town that regularly issues tax anticipation notes because they have a structural timing mismatch between their expenses that have to get paid versus the collection of their property tax calendar. The board tentatively decided that such governments would not always be considered nearly insolvent. It wouldn't be an absolute they are there, and in favor of letting governments use professional judgment in the circumstances. What might be nearly insolvent for one government might not be nearly insolvent for another. And so with that, we come to our first discussion question, which covers both parts of the details that we discussed. Do you agree that taking significant actions or the need to take such actions should remain part of the example indicators, and that governments that regularly operate close to insolvency should not always be considered nearly insolvent, and why or why not?
Feedback for Deborah?
Scott Deviney, AGA, agree. For governments that operate with little or no margin or working capital, completely agree with this. This was a concern our group raised earlier in the process, so thank you. We appreciate the board's conclusion there. Also agree that for the actions listed in the preliminary views, paragraph 22B, those should just remain regular indicators. Would note, though, I think there's a difference between indicators of financial stress and actions that would presumably meet the definition of insolvency. So I think that's where you would divide the line between things like, oh, we have to do budget cuts, or, think about services or something, versus like, yeah, we're going to decide to go into bankruptcy, or we're going to trigger debt guarantees, or, authority that can only be triggered when you can't pay. So thank you.
Michelle?
Michelle Waterworth, AICPA. We do agree with this on both fronts. Generally, we believe that if we were to add such prescriptiveness, we would no doubt run into example scenarios where a government might be taking significant actions or regularly operating close to insolvency, but are, for one reason or another, given the totality of the circumstances, not nearly insolvent. So we believe this provides appropriate flexibility to use professional judgment.
Harriet?
Harriet Richardson, Association of Local Government Auditors. I agreed with both of these, but as far as those operating close to insolvency not always being considered nearly insolvent, I think that you also need to think about whether the circumstances could change so that, because they are operating close to insolvency, and the actions that they take could to prevent insolvency could end up going away if something severe happens, that they would need to be disclosing that situation. So I think you have to leave an open space for that. Thank you.
Dean?
Dean Mead, NFMA. We agree with both of the items in this question. I think with respect to the first one of the taking or need to take significant actions, I think maybe significant is not a good word to use here, given the baggage that it carries with it. If you ask me for another word, I'm not sure I can come up with a better one right now, but like, extraordinary has, connotations of its own. But I mean, this is, we basically need a flaming chariot to come down and save us. Not, we have to, cut a small percentage of our staff or not fill certain positions where, we have to get rid of an entire department. That's distinguishing those, will be important to that item. And then the other, I think, probably need some further development of what type of government we're talking about here. But the concept that, an entity is routinely, is the obligor on this debt issue, but we know that they don't have enough money to make those payments, and their parent government is always going to make those payments for them. So if you ignored that fact, and looked at them all by themselves, you might think, well, they can't afford to repay their debt, but that's the way it functions. The cash flows happen every year. There's no expectation that entity is going to raise its own. So I wouldn't want to include that as a government that is insolvent, because that's just the way financially they work. But there's a there's a lot more probably that needs to be done here to flesh out that this notion so that it's clear to everybody what type of government you're talking about excluding from the disclosure.
Carl?
Carl Citroen, agree as well on both fronts. I think from an investor perspective, the actions taken to avoid insolvency are very useful signals. I think just operating at around the margin, we sort of expect for a lot of issuers. So that in itself, I don't think should be a classification of insolvency. Then the last point was sort of around, I think the disclosure itself is most important. The classification, maybe less so.
Stephen?
Stephen Stewart, Governmental Research Association. We agree with both questions, for the reasons that others have stated. I mean, GASB is, with the point about the example indicators, it's acknowledging that the government, as it tended toward insolvency, would likely take actions to avoid going further, and those can be some of the most visible indicators to the public. And then we also agree with, allowing professional judgment in those unusual circumstances. Thanks.
Bob?
Bob Land, Association for Budgeting and Financial Management. The budget folks would probably take a little different perspective here. Insolvency is the end of a very long process. And it seems to me the GASB's offering, trying to intervene at a point where the train has long ago left the station. Would GASB want to be a part of of making local governments aware of the problem and helping to identify solutions to that problem, or to simply make governments aware that, oh, you're insolvent? Well, I'm pretty sure they know that they're insolvent. I knew that long ago. And in fact, the way the word insolvency was used throughout the discussion here had a corporate sound to it. It didn't sound to me like this was a government insolvency, which is invariably gradual, probably the result, not invariably, but often in gradual, often the result of a year, multiple years of poor decisions. So my suggestion is to think a little more broadly than just insolvency as the culmination of an unfortunate process, and to move back up the chain a little further to address that issue.
Chris?
Chris Jumper, Bond Insurers. So as far as the governments that regularly operate close to insolvencies, that's their normal course of business. That makes sense. Again, insolvency is a concern for users and for investors. So I would want to have some early indication if it was heading down that way, other than just sort of an unqualified opinion. It's fine.
Rob?
Rob Weber, Bond Raiders. We also agree with this as well. We see lots of governments who are issuing tax anticipation notes that are not anywhere near insolvency or even severe financial distress, for that matter, just based on rules in which they have to live by. They can't move funds at the end of a fiscal year, so they're kind of stuck to have to do this borrowing. So I do agree. I think having the professional judgment here is a very important aspect of this.
Tyler?
Tyler Montana Prescott, NACO. I was just saying we would certainly agree that governments that operate close to insolvency shouldn't always be considered insolvent, just because of that, based on when cash flows come in, property tax revenue, things like that. And ultimately we need, to be able to leave things for professional judgment of the county governments.
Sean?
Sean Hunstock, APPA. I think it'd be good to define who is taking action here. Is it the government? Is it management? Is it the governing body, the elected officials? So I think it'd be good to be, more specific with that part of this provision.
Rob Hamilton, NASAC. Our group, we agreed with both with the board's tentative decisions on this. I think for the second one, I think wanting to avoid a false positive, which I think is part of the rationale there too. So again, we're supportive of the board's tentative decisions on these fronts. All right, back to you, Deborah.
All right, thank you. So the second topic for this part is going to be about the forward-looking assessment. And there are 3 details here that we want to get your feedback on. The first is using the likelihood threshold of probable. So as has happened in many other projects, the board considered multiple different likelihood thresholds and ultimately believes that probable would, even though there is some perhaps some different interpretations of what that means in practice, that would still capture most of the governments that the board wants to be included in this disclosure requirement. The second part is the time frame looking forward 12 months. The board considered whether there should be a set time frame or something a little more judgment based, such as the shortly thereafter that we currently have in Statement 56. They believe that the set time frame is preferable to the judgment so that everybody has the same time frame. And 12 months typically represents a government's operating cycle. And then the last detail is about whether or not a government's plans should be considered in evaluating the likelihood of it becoming insolvent. Similar to a decision reached in Statement 102, with a similar type of situation, the board has tentatively decided not to include management's plans in that assessment because they might not ultimately occur. And so our second discussion question for you covers all of those points. Do you agree that the forward-looking assessment should be defined as probable that a government will be insolvent within 12 months, and that the likelihood should not include a government's plans? Why or why not?
Sophia.
Sophia DeCaro and GA agree that they should be defined as probable so that there's transparency and on the risk there. And also agree that it should not include a government's plans just because you're not really able to bind future legislative bodies and it takes legislative input, whether the local, state, or whatnot. And you may not know, nothing's guaranteed, I guess, until it happens. And so I think it would be premature to include a government's plans. Yes, thanks.
So I'm going to add my comments at this point in case that I'm curious what any others around the table are also curious about in response to my comments. So the thing that I was looking at this, because I know it gets back to that, I think it was alternative 4 within the car scenario, which still I think was a real home run in terms of how that was captured. The area that I struggle with, and it's identified a little bit later in the paper, is concept statement 7, paragraph 10B, as it relates to that second yellow car. Because it seems to me that this is making a prediction about future events on future financial position. And that's listed as one of those items that's not appropriate for disclosure in the financial statements. And so I'm still trying to wrestle with that. And so I mention that because it informs how I respond in terms of the forward-looking assessment. To me, therefore, it should be reasonably certain because I think it's therefore less of a prediction around what that future event might be on future financial position. And then totally supportive of not having information about management's plans on that. Yeah.
I can respond to that because I don't think this is in the GASAC paper. It was in the board paper for this month in the fuller discussion. Concept statement 7, that paragraph is about the information that actually goes in the note disclosure and doesn't necessarily constrain the disclosure requirement, how you know if you have to make the disclosures. So there could be you could, in theory, have to make a prediction about the effect of future events in order to know if you have to make the disclosures, but then you couldn't put the prediction itself in the disclosure.
Okay, I'll have to think about that, I think, a little bit. But, I appreciate that, Deborah. The only other item that was brought up by my committee was just, I think, questions around like significant and what that all might entail. So, and actually, that gets back to the earlier question one, so I missed that a little bit earlier.
Rob, just to put some color to what you just said, because I do think this might be a conversation we have right now, so it's okay. But think of 102. Right, in 102, you have a disclosure when you have an event that's already occurred, occurring, or going to occur within 12 months. The financial statements are available to be issued. So, but in the disclosure criteria, in the disclosure requirements, you disclose the event if it's occurred, if it's occurring, but you do not disclose the event if it's more likely to occur or not to occur within 12 months. That's getting back to what Deborah's saying. You still thought about, was the event going to occur within 12 months to determine whether you had a disclosure, but you don't actually disclose that event. So that's what she's getting to. This is the same similar scenario. You could look at this and say, hey, maybe 12 months from insolvency to determine if you have a disclosure. It's a very different conversation related to Con 7. It's actually what you would actually put in the disclosure. Right now, you're just trying to determine, do you have one? Right? Which is different than what do you disclose? Does that make sense?
How do you inform the disclosure then in terms of?
That's different. What you might disclose and related to this topic is a topic conversation. Okay. But if you just think about it in terms of 102, right? One of the requirements was that event's going to happen within 12 months of issuance.
Yep.
That could trigger a disclosure. But in the disclosure, you would actually not talk about that event. You would only talk about the ones that have occurred or the ones that are occurring.
Okay. Thank you, Alan. Dean.
Dean Mead, NFMA. I'm not going to take the bait there, Alan, because I would love to have a conversation about what you just said. I'll save it for a break. Just can I get a clarification? Within 12 months of
the date the financial statements are available to be issued.
Okay, thank you. So probable, as much as we'd like to, get this sense of impending doom as early as possible, we are also not interested in getting false positives. So probable seems to be better than the only really firmer probability, which is more likely than not. That I think there would be difficulty figuring out, well, is it a better than 50% chance that we're going to be insolvent? That means there's a 50% chance they're wrong if it's right at the borderline there. So, and then it should not include the government's plans. Absolutely not. That being said, that's if they have some solid plans in place, that might be something we'd want to see in the disclosure. If they've got they're putting together a plan to recover or to stave off insolvency, that sounds like the kind of thing we'd want to know about, because that's one of the first questions we're going to ask if they make this disclosure and say they're experiencing severe financial stress. Or going, okay, what are you doing about it?
Harriet Richardson, Association of Local Government Auditors. Yes, we agreed with this. The indicators typically occur before the 12-month period, but 12 months is more definitive about probability, so agreed with that. Also agreed that should not include the government's plans, because plans don't always get implemented. If it's a plan, it's something that may occur, but it's not necessarily going to. And like Sophia mentioned, it usually takes legislative action to make sure that the plan is going to be implemented. So I think it depends in part how you define plan. Is it something that's been approved, or is it something that's still kind of in the development stage? So I think defining that would be helpful. Thank you.
Scott
Deviney, AGA, strongly agree. Probable, it's converged with FASB. It's the right level. Insolvent, meaning unable to meet obligations as they come due. Converged with FASB and extant. It's auditable because it's unambiguous. It's conceptually correct because that's when the going concern assumption is broken. Within 12 months available to be issued, converged with FASB, reasonable, parallel to GASB 102, and probable dissolution. No more ambiguity. It's smart and appropriate. I'm a super fan. Yeah, not including government's plans. Totally agree. Again, converge with FASB makes sense. Parallel to GASB 102. And I think to this point, I'd really suggest writing it as close to FASB as possible, where I think they do a good job of making it clear that an action that's finalized, like a final action, becomes a subsequent event, whereas like something that's planned or in process, that is not to be considered because it's not done yet. The only kind of chirp I have is I didn't see convergence cited in the paper as like a reason, and I just want to emphasize that like our group thinks that's a really valid and important consideration for GASB. Every divergence creates a social cost of everyone having to learn and apply like some different criteria, or maybe not learning it and instead incurring the cost of like mistakes or misunderstanding, et cetera. So I think convergence is especially important for this topic due to its significance, like how important it is to users and to governments, and because of the connection to audit standards. I'll respond. I've reached my word count, so I'll talk about Rob's stuff in a future question.
Sam?
I guess I'm going to respond using both. I'm a preparer, but I'm looking at the lens of a user, both. I agree, and I'm defining probable as being more likely than not. Okay. And I agree with that part, more likely than not that a government, and accepting the definition of insolvent, which means you can't pay your bills within 12 months, and that's the annual cycle of a financial statement. I would say that, I think of management questions in an audit and the answers to management questions. I think some disclosure about if there's it's more likely than not that the government's going to be insolvent before the next issuance of financial statements. As a user, I would like to know, I'd like it disclosed, and I'd like to know what they plan to do about it. And so I guess those are my thoughts with respect to this question.
Michelle?
Michelle Waterworth, AICPA. We do agree on all 3 points here. As to the probability assessment of using probable, we think that's a sufficiently high bar, but not too high, where it would exclude the right disclosures. And it's also not too low, where it would bring in those false positives, as Dean mentioned. We also agree with the 12-month forward-looking period. It gets rid of that ambiguity that's in GASB 56 of a short time thereafter. And we also concur with excluding government plans, as it enhances objectivity and comparability.
David?
David Goldman, National League of Cities. So I'd like to use a real world example of how this would work if you were putting a report together. So I guess my question would be, let's say that you're a city in Florida and your city derives 75% of their revenues from property taxes, and your fiscal year ends on September 30th, 2026. Let's say there's a vote scheduled on November 3rd of this year, where if the voters vote, over 60% of the voters vote, then property taxes will be cut significantly to take effect on January 1st, 2027. So when you're putting your report together for the year ending September 30th, 2026, how would you handle this? What do you Because let's just say the property taxes were cut, the voters voted for it, and the property taxes were cut, you would probably run a risk of, being insolvent or having to make some serious financial decisions. How would you report that? Or would you not report it until it actually occurred?
David, I think that's a very interesting conversation because I think you have like multiple things going on. Number one, you probably agree with me, you have a subsequent event.
Yeah.
Right? I would probably argue with you that you have a 102 disclosure. Right? Property tax being a concentration of revenue, right? Substantial impact potentially. And this event definitely probably gets you over the substantial impact bar. So now you've got a subsequent event disclosure and a 102 disclosure, right? And if it went in effect in January, are you gonna be 12 months? When did you issue the report? Your September year end, you issue it in March. Okay. So you're going to solve it 12 months from March. Some governments might be, because they don't have enough fund balance, they don't have enough reserves, they don't have enough other sources of revenue to actually not be insolvent. And therefore could be in this world. Some other governments might have plenty of reserves sitting around, plenty of fund balance sitting around, where they're maybe 2 years out or 3 years out before they're going to cross over the 12-month threshold. So I think in this scenario, you've got a subsequent event disclosure. You've probably got a 102 disclosure. Whether or not you're going to be in 12 months from insolvency when the financial is available to be issued, so you're 12 months from insolvency as of March 31st, it's going to depend on a lot of other things. And it's not necessarily a one-size-fits-all answer. So you have to assess that essentially. So you could be in Florida, and of the 67 counties in Florida, you could have 34 of them having disclosure and 33 of them not. And it's because they're not all equally the same from a financial standpoint. Does that make sense?
Bob? Bob Scott, GFOA. I don't have a lot to add that over what's already been said. It should be a very high threshold. And one of the biggest things to try to teach elected officials when they first come on is that you speak as a body, not as an individual. And there's all sorts of things out on social media and other things where council members or others will express opinions. And yet, until we tell our council 4 is more than 3. So you have to take official action. So I totally agree that you should not, the government's plans are typically just the government's plans. They're not an official action. So I agree on excluding.
Rob?
Rob Weber, Bond Raiders. I think generally I'm in agreement here. And as Bob just said as well, I'm not going to go back and reiterate everything that everybody has already said. I do agree with Dean in the event that you have something that you can point to, you should probably disclose it. But I'm not going to sit here and say it's required. The reality is, and the hope here is that if we've gotten to this point, I already know what their plans are. I mean, I shouldn't be guessing what their plans are at this point, or hoping that it's included in an audited financial statements. I'm hoping that we've already put this at a level that is, representative of what their rating should be. But if it's not, and it became this one big surprise, then yeah, I mean, it would be very helpful if you had something in there that was going to disclose what the plans were. But I'm not recommending that we make it a requirement. It would be helpful. It would not be a requirement.
Jill?
Following up on Rob's comments, Joel Levy, ICI. Following up on Rob's comments here, I think from the investor perspective, we want to know what people are doing. And I think that hoping that they disclose it is aspirational, especially when I consider that their ability to disclose things just to me, like I called them on the phone and I said, I'd like to know what other plans are. Well, in many instances, they can't because that's non-material public information. And so I think about just from the investor perspective, a person who has a portfolio with 50 municipal bonds to the extent that they're able to get the information that they need to make an educated choice. I would also say that the plans, of course, can change. Nothing in the plans is permanent, but that's, in my mind, as an investor, what makes it sort of interesting, because one's willingness to put a plan out and follow through on that plan, in my mind, dictates to the competency of the board that made that plan in the first place. So I do like the idea of having plans out because I think it gives me a level of information I might not otherwise know. And then I can make the assessment if I think that that's a valid plan, if it's a reasonable plan. But being a educated investor requires a level of information for me to know if your plan makes sense.
Harriet?
Harriet Richardson, Association of Local Government Auditors. So I had some thoughts in response actually to the last two sets of comments that were made about disclosing what the plans are and whether the plans are aspirational. So in previous meetings, I've brought up the context of transit agencies. A lot of them have not recovered from COVID fully with ridership, and their revenues are way behind. So I think about the transit agency I worked for, and in the San Francisco Bay Area, there are numerous transits. There's actually 26 transit agencies, and they are all running deficits. And the one I worked for is expecting a 350 million annual, meaning it's going to be cumulative deficit over the next several years. And so their plan is a ballot measure to increase sales tax, along with several other ballot measures that are increasing taxes. And how much can the taxpayers actually absorb for that, and how many of those ballot measures are going to get approved? But on top of that, the ballot measure doesn't even cover the full 350 million. It only covers about half of that, or a little less than half. And so the plan is out there, but the plan isn't realistic, and it's not going to cover everything that they need. So what should the disclosure be? That we still are on the path to insolvency, or what are we going to do to get the rest of the revenue when we know our ridership isn't recovering to bring us back to where we were before, and this plan that we isn't sufficient? What do we disclose? And they're not disclosing anything. And I think this particular statement all along I've been very interested in, because I think it's important. And I just don't see that not disclosing plans would be helpful, even if it's in this situation where you have partial plan and not a complete plan, but they don't have a plan B for what they're going to do after this ballot measure. If it succeeds or doesn't, they still need a plan B, and that's not even in place. So I think that there's more that needs to be thought about as far as what needs to be disclosed and how much and when. Thank you.
Hey, Deborah, tell me if I'm wrong on this, and I'm wrong on how I'm thinking about this, but I think what we're talking about in terms of management plans is in the FASB literature, once somebody determines that it's probable that they've broken the assumption of going concern. One of the things they have to do to assess that is to say, what are management's plans? Are management's plans going to take into account to mitigate that they're not actually going to break the assumption? So in other words, you think somebody's 12 months from insolvency, and you say, well, what are management's plans to address that? And the FASB rule, if they get comfortable enough, those plans will address that, and they'll never get to insolvency, they don't have a going concern disclosure. In my mind, that's what we've been talking about in related to management plans, more of that than talking about what are the disclosure requirements we might put in the actual note disclosures. Am I wrong on what I'm thinking about? Because there's essentially two different things going on, right?
Right. So we are still talking about the disclosure requirement.
Right.
And so you're trying to say, is it probable that we will be insolvent in 12 months? And do we factor in the plans when we're deciding if it will be probable or not? We are not at this point talking about what actually goes in the note disclosure if you need it. Kind of what we were talking about earlier. Those could be two different things. So, but yes, in the FASB world, they have, here's the disclosure if it's probable and the plans do mitigate it. Here's the disclosure if it's probable and the plans don't mitigate it.
Right. I think what we were trying to talk about initially is we're not really to the disclosure requirements yet. What we're talking about right now is, would you want somebody to take into account management's action or response to being 12 months from insolvency to determine whether or not you even have a disclosure? Let's not talk about what's in the disclosure yet. Let's just talk about, do you even want one? In other words, and I think the board decided not to do that. In other words, the board said, we don't want management to be able to tell us all these grand plans they have. And because of that, we therefore don't have a disclosure, even though all the numbers would suggest you're 12 months from insolvency. That's very different than what's going to be in the disclosure. We haven't got there yet. Is that fair to say? At least in terms of redeliberating the PV, we haven't got there yet. So I just want to kind of morph. There's two different conversations going on. And I think a lot of the conversations right now are about what you would disclose, which is slightly different than would you use their plans to determine if there's even going to be a disclosure. So I think those are slightly different conversations.
Thank you for adding that, Alan. Bob?
Again, Bob Bland, Association for Budgeting and Financial Management. I think GASB is missing an opportunity here, and I want to make the case. I think insolvency is not the issue, and Harriet brought it up already. It started much earlier. It started with changes in the ridership. David brought up an issue as well. It may change because of an election. In David's scenario, there may well never be a insolvency for that particular city or those cities. They're going to respond as any other political body and curtail their budget. They're just going to cut their budget. This is what our citizens want. We are a nation governed by democracy, by people rule. So if that's what the people want, the decision is pretty easy to make. We will curtail spending to the level that we have in funding, use up our reserves, and move forward with what we have. Sometimes governments choose to disincorporate. Okay, that solves the problem as well. There's no insolvency. I did a Google search, and by the way, I appreciated earlier Joel mentioned the value proposition of financial reporting. I think here GASB has a wonderful opportunity to elevate the value of the financial report by highlighting issues earlier in the process than once it's a crisis, once it's an insolvency or whatever the case may be. I think I appreciated the car diagram as well. I thought it communicated quite nicely. And a lot of cars are in the, did I get it right? Yellow and the green area, yellow and the green area. I might have missed it. Anyhow, a lot of cars are near or probable, but in fact, governments are remarkably resourceful at finding solutions to their financial problems. So I would just make the case that I think Harriet illustrated it quite nicely, that problems begin earlier on as budgets. And in the budgeting world, we call it a budget deficit, a chronic budget deficit, a budget deficit that is likely to exist for multiple years that may lead to insolvency, but typically is resolved long before that point. It may lead to bankruptcy without the insolvency, which is entirely possible, and as a result, also be resolved there through the bankruptcy process. I Googled insolvency for governments. And I could not find any case where there was insolvency. Now, there may well be, but insolvency oftentimes is the end result of a very long, complex process of systematic, sustained budget deficits. And I think identifying those early on with appropriate safeguards or appropriate conditions that GASB could determine, that would highlight the problem and bring the problem to the fore for legislators to address. They certainly are going to know that it's a problem. And so anyhow, I exceeded my word limit here already too, so thank you.
For the record, Joel is a new member. There is no word limit, so you can.
I just want to say you got me on that. I was like, is there actually a word limit?
Sam.
Good to know there's not a word limit, but I don't speak a lot. I stand by my comments. I think with respect to disclosure, it's better to have more disclosure of a government plan than not. The example I used at the last meeting about going concern was the city of Chicago's not going to go out of business. They'll go into receivership. But Harriet brought up a very good point. A transit system very well may stop operating. I'm sure there are transit systems, especially in California, I think, that have either scaled back or eliminated if they can eliminate deficits. And so, given that, it sort of buttresses if I'm bondholders, and I'm sure they issue bonds at your transit authority, which are as valuable as this my name plate there is not so much. I guess what I'm saying is I agree it isn't it happens in a long period of time to what everybody has said. And I guess you just have to keep raising the alarm through the financial statements so that, and again, to another person's comment, having a plan is better than not having a plan, and then users can make their own judgment on whether the plan is realistic or not. But I think that needs to happen. I'm not as familiar with what 102 disclosure is relative to this, but again, I think more disclosure is better than less, especially when it's more likely than not within the next 12 months that the governmental entity isn't going to be able to pay its bills, be insolvent.
Carl?
Carl Citroen, in insurance industry investors, generally agree with probable and the 12-month period, and echo the comments of Bob Weber and Joel Levy. On the last part of the government's plans, I just wanted to raise the attention to that a lot of the deals, we look at, they either have a general obligation pledge or some sort of revenue pledge where they set rates sufficient, to cover expenses and debt service, or this full faith and credit pledge. And that, I wonder, how's that baked into a government's plan? Because that's what they sort of attest to when they issue these bonds, that they're going to do whatever it takes to satisfy these obligations. So while I agree to a certain extent, it might, needs to be taken out of the forward-looking assessment, it's also very difficult not to do it, especially from where we are sitting on the investor side, because we generally assume those are the government's plans. I don't have the answer to the issue I just raised. I just wanted to make other people aware that these legal securities are things we as investors think about.
Well, and before I get to Dean, to what you just raised, Carl, I think of in our state, we have general obligation bonds, and we have a provision that if we cannot pay them, we're going to raise a statewide property tax that would be then used to satisfy the bond payments. And so I think in the way it's proposed is that plan would not be part of the analysis as to whether we're in severe financial stress in the next, or nearly insolvent in the next 12 months, as I understand what you just raised. Dean?
Dean Mead, NFMA. I just wanted to follow up on this issue of the government plans. That there would be no disclosure if potentially no disclosure from a government if we allowed them to consider things that they plan to do but haven't done yet when they're evaluating the likelihood of being insolvent or nearly insolvent. And so, as with Statement 102, where they can take actions that mitigate the risk to a degree that now they no longer have to disclose. That's the case here too. But like 102, if they haven't done it yet, the fact that they plan to do it's not good enough, and you can't presume that they are going to follow through or they'll be able to do what they say they're going to do, and so that shouldn't remove them from the requirement to make the disclosure. But I'll repeat what I said before. We sure would be interested to hear, what plans they do have, if they are required to make the disclosure that they are suffering from severe financial stress.
Joel?
Joel Levy, ICI. I just want to maybe bring something to folks' attention who may not realize this from the investor perspective, is that for the vast, depending upon which number, you'll know this part, but depending upon which number you want to believe, there's somewhere between 50,000 and 80,000 rated entities. And most people in their individual portfolios don't realize that there's a financial problem. I'm not talking about the professional finance folks like us at Duveen. Obviously, have people dedicated to reading every financial report that comes out. But there are many people, I'll just take my dad, who's a truck driver. I like to use him as sort of one sort of gauge. And so when you think about his individual portfolio, the only time he's really going to realize there's a problem is if there's a rating agency downgrade, or something comes out in the media that says, my goodness, something happened, you should know this, because he's not looking through the financial disclosures, he's not looking through sort of notes. And so I just think this is such an important issue to have that information in those plans, especially when you consider how many entities only issue once every several years. And so the large issuers, I think, are just covered by the nature of how they issue. But those smaller issuers, they issue once every 5 years. Information like this, I think, is materially important. I couldn't think of anything. I'd be hard pressed to think of something that'd be more important to an investor to know what the plans are in the event that there's a going concern or could go to that outcome. Thank you.
David?
David Goldman, National League of Cities. Just the last two commenters got me thinking. I'm just thinking there is a big difference between saying that, we're nearly insolvent if we don't do anything, or we have a significant risk next year that we're working to mitigate. Because, I guess representing the National League of Cities, I have to think of what our elected officials would think from a political and reporting standpoint, because saying something in a financial report using language that makes sense to, accountants and auditors is one thing, but oftentimes the press gets a hold of some language and misinterprets it accidentally or otherwise, and it actually ends up becoming almost like a self-fulfilling prophecy when you put a disclosure out there that is being worked on, but if you put it out there, and it's misinterpreted, then it actually ends up causing a problem where it makes it harder to actually get the mitigation done because the word got out that something was worse than it really was. So that's just something to think about too. I think the goal would be if cities and counties and agencies are having issues, I think we all would want them to come to a good solution, come to fruition with a solution that resolves the issue than pre-disclosing something that might actually end up working against what I think all of our goals would probably be.
All right, Chris?
Chris Jumper, bond insurers. So I got to believe, and I'm almost sure that there's EMMA disclosure requirements for events of default or failure to meet bond covenants that would be available to investors. I'm not a big fan of including the government's plans in the decision whether to disclose or not, unless they've been executed and put in place within that time frame that we're talking about.
Good discussion. I don't see any other tents up. Back to you, Deborah.
All right, thank you for that. We're now going to move to some topics that the board will be discussing at their meeting later this week. And the first topic relates to these governments that are probable of being insolvent in 12 months, but are not otherwise would be considered nearly insolvent. In the diagram, we've been referring to these as the second yellow cars. They are not in very poor financial condition, but they're expecting to go downhill very quickly, all the way downhill to becoming insolvent. And so the first question is whether those governments should be required to make the same disclosures as the governments that are already insolvent or nearly insolvent. Or in another way, should the same disclosures be made for a government that is in a condition versus at risk of becoming in the condition? And so as we've already alluded to, the board has not yet redeliberated what the disclosures are actually going to be. We do have the list that was proposed in the preliminary views, obviously subject to change based on respondent feedback and other topics. But some of those items that were proposed in the preliminary views, which were written for governments that were in a condition of being insolvent or nearly insolvent, they might not be relevant or applicable to a government that is only probable of being insolvent, but not in that condition. And on the flip side, there might be some additional information about a government facing that risk of insolvency that was not in the proposals in the PV. Of course, any of that we would have to evaluate against Concept Statement 7 to see if it's appropriate for notes. So if the board says that, yes, these governments should make the same disclosures, we have two options as to a path to go down that. One is to expand the definition of nearly insolvent. In the preliminary views, we had discussed this as being only about the severity of their situation and not about time. We could expand that, though, to include the time element and say that those governments are nearly insolvent. Or we could rename what we're calling these disclosures so that because not all of the governments making the disclosures would be in severe financial stress, we could come up with another term than severe financial stress disclosures. But if the board that says that no, these governments should not be making the same disclosures, then we have, again, two options. One is to say, then let's make the forward-looking assessment a separate disclosure requirement and have the separate disclosures for that. Or the other option is to not require those second yellow car governments to make disclosures under this part of the project. So discussion question number 3 is, do you think that a government that is probable of being insolvent in 12 months, but is not nearly insolvent, should make the same disclosures as a government that is insolvent or nearly insolvent, and why?
Linda?
Hi, Linda from American Accounting Association. So I have a technical question from an educational perspective. How do we distinguish between your insolvency and probability of becoming insolvent? Related to that, probabilities. We teach and our students work on this all the time in class. How are we defining probability? Are we talking about a 50% probability? That's vastly different than the risk of a 90% probability. So when we're doing risk assessments, what do we put weight on? 50, 60, 70, 90%? And so those are just some technical questions from a user perspective that I had.
Yeah, so I think to the first part, this paper doesn't have the whole context of what was in the preliminary views and the other topics we haven't gotten to yet in redeliberations. In the preliminary views, we had like this long list of example indicators, things for people to consider. Nearly insolvent was described as being, it's really bad financial condition. It's a very severe condition. They may or may not be getting worse. And so they may be really bad and probable of becoming insolvent soon, or they could be really bad and just hanging out in the really bad camp. So do you want to?
So quick follow-up, risk preference, right? How do we account for the manager's tolerance for risk, right? One governmental management team may think we're more risky than the other. So I guess from an educational perspective, how do we distinguish tolerance for risk? When do we think we're approaching it, near it? And then what are some of those probabilities? Again, is from the classroom perspective, 50% probability is vastly different than 90% in risk tolerance.
So at least in the preliminary views, there was, it was a lot left up to professional judgment. And so I think the risk tolerance would.
So managers have a higher tolerance for risk.
So that's a great comment for when we get to that part later. And then the other part about what is probable, it's not defined. And that has been one of the, I don't want to say problems necessaries, but drawbacks to using that term. When we use more likely than not as a likelihood threshold, we have defined that as more than 50%. But that is the only likelihood threshold that we have put a number on.
Yeah, I'm struggling with that too, because in the classroom, again, when we talk about risk assessments, 50's not even in the ballpark as 90, right? But I don't know how you put a cap on that. Thank you.
Scott?
Yeah, we think the yellow cars should all have the same disclosure. Again, convergence. I don't. So I'll respond to Rob's comment from earlier. I don't see an issue with the concept statement. I think the presumption is that governments are a going concern until you have information right now that leads you to doubt that, and that's what triggers. It's not predictions about the future. It's information you have right now that you see is going to like reasons or causes are known. The evaluation of significance is something that you are doing right now. Actions taken are not a prediction. I think plans are something that, again, as long as they are described as plans, the plans exist right now. They don't exist as actions. They exist as plans. So, for example, we've issued reports where you get to the discussion of management's plans and we say they don't have any plans, and that's the information that exists right now. Or they do have plans, and you can. I think AICPA has great guidance for how auditors navigate those types of situations. I think it's the same as GASB 102 or MD&A requirements to talk about currently known facts and conditions. But in terms of these options, I think the what we would like to convey is that I think the yellow cars they're both something that needs to be disclosed, and I think that the challenge with this question is how do you differentiate between that second yellow car and the green car. And we would, that's why I think our real answer is like, yeah, we think we should just strike the green car and just get fully back to convergence. And the main reason is because we continue to be just incredibly skeptical that we'll be able to define the green car situation in any way that is auditable, that is can be consistently reported. So I have a word count, Joel, because I do talk too much. So that's not for anyone else. Thank you.
Dean?
Dean Mead, NFMA. So I think these do need to be two separate sets of disclosures. One for the governments that are judged to be nearly insolvent or insolvent at this time, and those that have concluded that it's probable they're going to be insolvent within 12 months of the date the financial statements are available to be issued. So I think for both of them, 2A and 2B, the reasons and causes, the government's evaluation of the significance of those reasons and causes, I think are relevant to both. I'm not sure C is relevant to either of them. If actions taken in response to the condition, that's definitely not, I think, relevant to the expectation that it's probable they're going to, because they're not in that condition yet, so they wouldn't have taken any actions. But even here with respect to those that are nearly insolvent or insolvent, and they know that now, it doesn't matter what actions they've taken, they still have come to the conclusion, despite those actions, that they are nearly insolvent or insolvent. The known effects of the SFS condition, I think, is still relevant to those that are nearly insolvent or insolvent, but not for those that it's probable they're going to be insolvent. One would expect there haven't been any effects of it yet because they're not insolvent yet. So I don't think that part's going to be relevant. I do think, for governments that it's probable, which I believe means likely to occur in GASB literature, there is a definition of it, which is a little bit clearer than probable by itself, but still not a percentage. The fact that it is probable that it will be insolvent within 12 months of the date the financial statements are available to be issued is a worthwhile disclosure. And as I said a couple times before, if they do have plans for for dealing with that probability of being insolvent, I think we'd like to see those in the disclosure as well.
Michelle.
Michelle Waterworth, AICPA. I'm going to take the middle ground here, and I'm going to say we would advocate for similar but not identical disclosures. It seems like many of the same disclosures would apply, but there may need to be some tailoring, such as framing around risk of insolvency versus current SFS condition. In addition, in the paper, there was some reference to governments potentially having to make 2 disclosures, and so definitely don't want to advocate going down that path. So looking for a single flexible disclosure framework with tailored wording.
Harriet.
Harriet Richardson, Association of Local Government Auditors. Yes, I think that the disclosure of probable there should also be a disclosure for probable, because it's still indicating that there's a fairly high bar that they will reach near insolvency. So I think it should be disclosed. But like Michelle said, the content would likely be different if you're talking about probable versus nearly insolvent, even though we aren't talking about content right now. I do think that the content would be a little bit different when you say probable versus nearly insolvent. Thank you.
Sophia.
Sophia D. Caro, NGA. So I think that we have to be careful, depending on the answer to this question here. But if governments, if the probable governments are going to be treated the same as the insolvent or nearly insolvent by the users, I think you have to be careful, because that could impact their borrowing rates. It could impact, it could create a disincentive to be transparent, and they're likely working on a plan. If they're in a probable status, they're likely proactively working on a plan to prevent becoming nearly or becoming insolvent. And so I do think that the points Michelle raised, like how you contextualize the risk, matters. If you require some level of disclosure, and maybe it's a bifurcated disclosure, but then it starts to get complicated. I just think if you make it the same disclosure, it's likely going to result to that entity being treated as if they're nearly or insolvent, which I think could have unintended consequences.
Chris
Jumper, Bond Insurers. So I took this as looking at an entity that was actually financially sound, but was facing a change of law or a force majeure, an act of God, that change of taxes, change of control that will, clear and present, show it having difficulties within that 12-month period. And I think that should be disclosed, similar to the way it would as if it was happening already, or at least treat it that way.
Carl?
Carl Citroen, insurance industry investors. I think the disclosure should be slightly different, just to make a distinction between the current condition and something more forward-looking. So I think a tiered disclosure regime would be appropriate.
Rob?
Rob Weber, Bond Raiders. I guess what I don't like about this question is if you are probable of being insolvent in 12 months, but is not nearly insolvent, that's nearly insolvent. You are nearly insolvent into the next 12 months. You are nearly insolvent. So I think that part of this, I think, is very confusing. And if we're going to sit here and say, in the next 12 months, you're probable to be insolvent, then just drop the not nearly part, because it's very confusing for me as a reader to figure out what is nearly. I mean, as someone who's looking forward looking, 12 months is pretty near. But I'm agnostic as to how it gets put in. I think whether it's tiered or not tiered, as long as it's disclosed, and that your forward-looking view is that within the next couple of months, we're going to have a problem. We're not going to be able to make payments on something. We're going to put some bills in the drawer and not pay them. That would be helpful, because unfortunately, I have seen issuers who had healthy balance sheets who the following year did not. And they knew they didn't. And they knew they weren't making payments. We're going to have delay payments. So, even when we do have a call with them, if they're, we'll call exaggerating the truth, maybe not lying, at least it holds their feet to the fire when the SEC comes in and says, well, what were you saying to the investors? What were you saying to the rating agencies? Because what were you saying to the public? Because now you have this disclosure you have to put out that says in the next 12 months, you're nearing this level of insolvency. And I think it's going to hold management's feet to the fire a little bit more to be a little bit more proactive in their disclosure of where they are currently in their financial statements.
Stephen?
Stephen Stewart, Governmental Research Association. We think it would make sense to have two distinct sets of disclosures just for clarity in application. The disclosures for governments that are insolvent or nearly insolvent would, deal with things like describing the SFS condition, the things that relate to that particular situation that they're in. When you're probable of being insolvent, the ones that stood out to us would be things like talking about the reasons and causes why you're making this disclosure, the government's evaluation of their significance, and then any actions that maybe they've approved to be taken in the next 12 months, if that could be distinguished from a plan or a general plan, if you could talk about the approved actions to avoid falling into an SFS condition.
Can I ask everybody this is for my own personal benefit. If I think about insolvency being a really, really bad thing, you're there. It's just too late, but it's really bad. And nearly insolvent is a condition you're in as of a date. It's bad, but it's not quite as bad as being insolvent. It's kind of picking up on what Rob just said. But 12 months from insolvency feels like it's in the middle of those two things. So if SFS is insolvent or nearly insolvent, which would include everything in between the two, which would include 12 months from insolvency, why pull that out and have it be something separate? And why not just say SFS is anything from nearly insolvent to insolvent, which includes in between that, your 12 months from insolvency. I'm just asking for the logic of that. Because when Rob just said what he said, I kind of sat there and went, yep, that's kind of how I think personally. That's how I personally think about it. But just because I think if we all agree that if nearly is the least of these three questions, nearly is the least bad, for lack of a better word, insolvent's the worst bad, and 12 months from insolvency is in the middle of the two. I'm just trying to think through that mentally.
I would say we don't agree that 12 months for insolvency is in between the two.
No, I do. That's why I said it's personal. That's why I said it the way I said it. I said this is personal. So I said exactly the way because I do believe that.
Scott?
I think Bill was first. Unless you want me to go first.
Thank you. And I'll try to keep my words to the minimum, but we'll see how that goes. I apologize for missing the last meeting. I feel like this thing got totally different than where I thought it was headed. But what I'm hearing today, it's got me a little concerned because it sounds like, are we going to use the term SFS in this disclosure, or are we going to use the term insolvency? And I feel like they're being jumbled. My perspective is the SFS would be an indicator of a government that's in trouble, but hasn't, how close are you to the cliff, but you haven't fallen over? And when using the term insolvency, you're going down, right? You've crossed the cliff, you've jumped. I'm not seeing a lot of distinction to me when you're talking about these two levels of disclosure and whether you should or shouldn't. To me, that I was hearing the same discussion. So I thought the users and the bond folks and the insurance folks were looking for the governments to disclose trouble before they got over the cliff, right? And then, so am I totally off base on this discussion? But I am concerned from what I'm hearing because I'm not sure. I think it's going to get jumbled and readers are going to get very mixed up about what they're being told. Deborah?
Yeah, so to respond to that, to try to recap from the March meeting or what the diagram with the cars represents is what we've been calling in severe financial stress is cars that are beyond the dashed line in the diagram, which was labeled as very poor financial condition, which would include the ones that are fully insolvent over the cliff, and then the ones that are very close to the cliff, even if they're the first yellow car is very close to the cliff and it's likely going over the cliff. The green car is close to the cliff. It's not getting worse, or at least that much worse right now, but it's still very close to the cliff. And then you have the second yellow car that's farther away from the cliff. Currently, we would say it is not in SFS, but because of this impending law change or whatever is coming, they think they're going over the cliff soon.
Yeah, and I guess I was thinking just, again, the SFS issue would be more of hopefully preventative maintenance, for lack of a better way to say it, right? To the readers and to the government, mostly, right? To the government entity, like, hey, you're sick, you've got to do something here to correct your path. I don't know if that was the intent of the disclosure at all, but. Jeff?
I'll jump in while I still can. This is one of the few final decisions I'm going to have to do at this board meeting this week. So, just in response to what I thought about when I think about this question, right, is as we've described in the paper, this 12 months to insolvency thing is different than the other things. The other things are SFS is a condition, a current condition. This is now, I'm not in that current condition, but I think because of the circumstances that I could be 12 months from insolvency. So to me, the thing I think about is, do the users care about that distinction? What I hear you saying is, I don't think they do. I think we just redefine near insolvency to include this prediction, and you get one set of disclosures. My concern with that is if the user says, I want to know if the reason for this disclosure was because they think they were 12 months for insolvency versus they think they have this list of indicators and things that we've defined as, I tend to think the users would want that distinction, right? And therefore, I can't redefine near insolvency to include the 12-month prediction and just make it one set of disclosures. But that's really subject to what I think users want, and hearing maybe from the room, from users particularly, what they want. Does that distinction matter to them or not?
And I do think the readers do care, but I feel like the language is so connected here that there's no distinction about an entity that's potentially shown. I think the discussion from the individual down there was, well, over the years you've had deficits, or you've had a change in your tax law, whatever it might be. You may not be near insolvency, but if you don't take some action going forward, then potentially your history is showing, hey, you're in trouble. Now you've gotten an event maybe that occurs, you're going to be in trouble. I think it may be useful to the readers to say, hey, yeah, we're in this condition. I would describe it as FSS. And then insolvency is a different disclosure, almost like two terminology differences. So yeah, I think both are, when you get to the insolvency, hopefully you've already heard about the SFS. It would be my perspective of it.
I'm going to jump to Chris.
Chris Jumper, insurers. So again, what I was thinking was that you're a strong entity. You've got financial. You're meeting all your covenants. You're meeting all of your coverage levels. But there's been a change of law. There's been an event that has occurred, a hurricane, a flood that your people are underwater. That's a serious event that that again you're going to be determining in 12 months and 6 months and 9 months from that event. I'm not going to be able to pay my obligations, in which case that's what I would want to be able to see in the disclosure that there's been an event like that.
Scott?
Yeah, Scott Davini, AGA. Yeah, I'd say I think that the green car is fundamentally different than the yellow and red car. All along we've been, our group has been advocating for like the convergence with GASB and with AI CPA standards, where our understanding is just is vitally important for the auditor to comment on substantial doubt about going concern within a reasonable time frame. I think that in terms of the green car, and we found question 3 and 4 both really difficult to answer because we were trying to respond for the yellow car, and I think it gets tied up in the terminology, to Rob's point, and it's kind of difficult to untangle. And to Bill's point, I guess we would just say, yeah, I think that green car is the issue. And if the board is looking at how to define that, if I think I'm comfortable with probable, but I don't know how you would define nearly insolvent. And if you can't define it in a way that everyone can consistently understand it, I mean, it's great, Alan, that's the way it is in your mind, but I mean, and I don't know how you put that down in standards other than just say it should be beforehand. So I don't believe it's actionable, and I'd be interested to see a definition. I think when we did the public hearings before, I was surprised to hear your views on it because it was just it didn't show up in the definition, I think. Now that said, I mean, I think we really respect the user's interest in getting an early warning. But again, how do you define what an early warning is? We could have done an early warning on 200 school districts last year, but only 10 of them ended up with a going concern the following year because they had a great ability to make changes.
Scott, in your scenario, You're just advocating for there is no SFS disclosure. There's simply a 12-month look forward disclosure.
Yes.
Which I appreciate, and I do appreciate that because you've been consistent with that argument. You have been. But really, what we're trying to figure out is if you have an SFS disclosure and you're 12 months from insolvency, is it one thing or two things? That's really what this question is trying to get at.
I think that the 12 months from insolvency should preempt the, that's the important thing at that point in time. Like, it doesn't matter now that you're nearly insolvent. All that matters is that you're 12 months from insolvency. Does that answer your question?
Yeah, I could read it. I could take that two ways, and I don't want to take it the wrong way. I don't. But I'm not sure how to ask the follow up in the sense that, like, if 12 months from insolvency is a criteria, for like a better word, or a tool or an assessment you used to determine whether somebody was nearly insolvent, in your mind, you would say, well, if you're 12 months from insolvency and you made that assessment, then you are nearly insolvent, and I want the disclosure.
If it's the same, like, that's the thing that's
but you don't want the nearly insolvent parts. That's why it's hard for you to answer.
But let's just say that those were two different disclosures. I'd say you just went from one disclosure to another disclosure. To Rob's point earlier, like, now you're just going to be confusing. Either you're nearly insolvent and you're not in that probability range, or you're in the probability range. Does that answer your question?
Kind of, but I think what Rob was getting at, though, and I'll put Rob, you can follow up on this. I think Rob was saying is, what I heard Rob say was, once you're 12 months from insolvency, you are nearly insolvent.
I'm just gonna put that down because I'm gonna respond to you anyway, Scott. But to your point of the 200 and the 2 or 10 or whatever it was, like, when the going concerns, I want to know about this 200. Right? I mean, that's 100% relevant, because when you get to the point of those 2 ongoing concern, they probably not going to be very highly rated at that point, right? The other 200 may be, and we may not have the right ratings on them. And so I 100% do want to know that this is a problem that's coming down the pike that we may not know of because we've got 10,000 ratings we have to do. So it does, I think, matter in that yes, it didn't come to fruition. Great, that's awesome. But they may have been rated AA2 and they're not rated AA2. They may be rated A1 now or A2. And so there may be rating distinctions between those entities because of this problem. They just didn't end up going on going concern. They didn't go down to BAA or they didn't go down to PA. Right. So there's, that to me, I think is a wide range of a difference of, kind of what we would want to see.
Joel Levy, ICI. I can appreciate why you wouldn't, the broader market would not want a list of all the people who could potentially be a problem, or the entities. The problem from an investor perspective is we, in many cases, own discrete individual bonds. So while it's true that many did not have an issue, and congratulations, great job on behalf of all those entities. The reality is there were several who did, and to be an informed investor, you have to have information, and I think that's why this information matters.
All right, real good discussion. I'm gonna pass it back over to you, Deborah, for the next question.
All right. So the next question is whether, and if so, how, a forward-looking assessment is used to inform nearly insolvent. The 2 options that were put forward in the paper are what we call the rebuttable presumption or a regular indicator. This is assuming that nearly insolvent does not mean time. So in the preliminary views, when we used that phrase, it was about the severity of the condition, how bad things were, but not about time to insolvency. One of the options on the table with the previous question is to expand nearly insolvent to include a time element. But question 4 is assuming that the board does not do that. So there's a lot of conditional things going on with this month's papers and questions. So the two options that were placed forward for using a forward-looking assessment to inform whether a government is nearly insolvent. A rebuttable presumption would presume that they are nearly insolvent, that is, their condition is that bad, unless they can prove evidence to the contrary, or a regular indicator, part of that list of example indicators that we talked about earlier, that was in the PV. So it would be considered, but would not necessarily be make the decision one way or the other. So question 4 is, if a forward-looking assessment is used to identify a government that is nearly insolvent, how do you believe it should be used? A rebuttable presumption indicator or a regular indicator?
Deborah, maybe just for me, as a quick point of clarification with rebuttable presumption. So the first item that would initiate whether this is a regular or rebuttable evaluation would be, there's a determination that it's probable of being insolvent within 12 months. Is that true? I'm trying to think of like what would be the first item that then this would be applied against.
Yes. So if it is probable that they will be insolvent in 12 months, then do we presume that they are nearly insolvent unless they can provide evidence to the contrary? Or is it just oh, well, that's one piece of information along with the other example indicators that we will consider in making that decision?
Thank you. That's helpful, at least for me. So I appreciate that clarification. Christine.
Christine Brock, ICMA. And on this one, I wanted to share something. Deborah and Roberta, they have a task force on this paper, and we had a conversation recently. And on the rebuttable presumption indicator, I'm not an attorney, and I'm not going to play one. We have a real one, a real attorney here at the end of the table. However, just a legalistic aspect of the rebuttable presumption indicator would lean me as a finance person to recommend the regular indicator. The burden of not just the burden, but the level of evidence and presumption that a legalistic indicator would require is different than a regular indicator, at least from a financial person perspective.
Joel, or was that from before? Michelle?
Michelle Waterworth, AICPA. In thinking through this question, we thought that the rebuttable presumption indicator would better elevate the importance of that forward-looking risk without making it absolute. We felt that it was stronger than a regular indicator, and it appropriately bridges the condition and the risk.
Darren?
Darren Tarleton, HFMA. I think rebuttable presumption is the right answer here. I've been a proponent of a forward-looking assessment going back pre-PV. I am still, here in the discussion, I'm maybe more confused than walking in, but maybe to Chris's admonishment, not getting hung up on the semantics of what we're calling things. And it's, to me, more of either you're insolvent or you think you're become insolvent, and we have disclosures around that. And that's separate from maybe the concept of, because the near insolvency without a time horizon and a probability assessment attached to it does just become confusing. So maybe there's a carve out for what near insolvency from just qualitative factors that is not saying we think we will become insolvent, that we will achieve that condition within a forward-looking time period. But anyhow, I do think if we think we are going to become insolvent in the next 12 months, that is a rebuttable presumption that you're near insolvency today, whatever that means. And I do think, skipping ahead to number 5, that all governments should make forward-looking assessments in whatever form this disclosure requirement comes out to be. And just for the record, I think maybe substantial doubt about an entity's ability to meet its obligations as they come due would be a nice way to articulate this. Thank you.
Dean?
Dean Mead, NFMA. I'm just going to tell you what I think, and then you can decide which one of those two it is, whether it's a rebuttal presumption or a regular indicator. I think that if the government does a forward-looking assessment, determines that it is probable that they will be insolvent within 12 months of the date the financial statements are available to be issued, that is sufficient. And they don't need any other evidence, because I would presume that that kind of evidence was a part of their evaluation looking forward. So I think if that's, if they have that, that can stand on its own. Is that a rebuttable presumption? It doesn't matter to me what you call it, but I think that's where I'm coming from.
Elizabeth?
I think regardless of whether you make it a rebuttable presumption or just forward-looking, you're going to use the same indicators to make the decision. You're going to use the totality of the circumstances. Like Dean said, you've gotten to a certain point, you've got all this information, and whether you move forward, you're still using the same information. I'm like, Dean, I don't know if that's a rebuttable presumption or not, because it's still the same information you're using to make either decision.
I'm thinking out loud here based on what Dean and Elizabeth just said. Is that, what am I trying? Is that an argument for either having a forward-looking assessment and nothing else, or having the other things and not needing a forward-looking assessment?
I'm an attorney. I can argue it either way. I mean, it's true. If the point here is to raise the flag, and whether that is a little flag saying, we have a tiny issue, we may be able to do something about it, or whether it's a really big flag and you're waving it really, really loud and proud, you're still going to use the same information. And I think it is important, whether you're a user or a preparer or the governmental entity itself, in having to identify which little flag, big flag, or whatever we're doing, you still need to use the same information to determine, do I tell someone about it? And I don't know if that does not answer your question. And I think that's part of the problem. Like, we know what we're talking about in general. We're getting caught up on words. Sorry, Chris. But I think that's part of the problem. We know what insolvency means. We know what not insolvency means. It's trying to define the middle, which we're trying to do. But we all know that it's the same types of actions, inactions that are going to determine whether we're the green car, the blue car, or the yellow. Because we're not worried about the red, because that's too late. I think it would be easier for a rebuttable presumption, because then you can say yes, but, and lay your case out there, and Scott can tell me if I'm wrong, but you can audit that, I hope. So I would think that it would be easier that way, but with the understanding that this is new and unusual, and there will be growing pains.
We'll jump back to Dean.
Just to respond as well. I think before you get to making this forward-looking assessment, you're first making your assessment as to whether you're in that position now. And if you conclude that, yeah, right now the conditions are there, we're close to the point of not being able to pay our bills, or we already are at the point where we can't pay our bills, then you don't need a forward-looking assessment. You're only going to take that next step if you think right now we're okay. And then you're going to ask yourself that subsequent question, which is, and are we going to be okay in 12 months? And I don't think that is as complicated a question as we sometimes make it out to be. It's not as if every government's going concern evaluation right now is a grind. I mean, in a lot of cases, it's like, obviously we're a going concern. And yes, do I have to document that and write something that will make my auditor agree? But there's cases in which they come to one conclusion, the auditor goes, what? Those are the exceptions rather than the rule. So I think the same case is going to be here. They're going to look at this and say, we're fine right now, and we're going to be fine in 12 months. So this is, stepping a little bit into your next question as well, I think. But I would think that this is an expectation that every government would have to go through this evaluation process. But that doesn't mean they have to do this gigantic spreadsheet and multivariate analysis. And, it's more like if they have any doubt whatsoever, then they need to start digging a little bit deeper in this evaluation. But most governments probably won't have to do that.
Sophia?
Sophia DeCaro, NGA. My mind is trying to simplify what I read, and I hope I interpreted it correctly, so I may not. That's my disclaimer. But in my mind, and Elizabeth used the word pain. So in my mind, when you go to the doctor, you get a pain scale, and you have to point, which smiley face is it? Is it frowning, or is it, you have this pain point scale. So in my mind, the rebuttal option is almost like another category of pain than just being considered one of the regular indicators that would, I think, result in you being treated the same as if you were insolvent or nearly insolvent. So back to my former comment of, if disclosing it is going to result in being treated the same as if you were insolvent, I think there's some unintended consequences that could come from that. Especially if it impacts the rating, the rate, and the borrowing costs that would come as a result of being rated more poorly, for example. So I think that if my interpretation is that the option of rebuttal is to have another notch of not quite there, but because right here the language says unless there's evidence to the contrary, it gives you that kind of out that, well, I do have some evidence to indicate that, I'm nearly insolvent, but maybe if there's some evidence that shows that maybe that can be corrected, that seems to be different than if it's just treated like the rest of the indicators. I don't know if any of that made sense, but in my mind it did. Thanks.
I would argue that nearly insolvent, Sophia, at least in my mind, doesn't make it binary. You could make an argument that if you did a forward-looking assessment and you determined you're 12 months from insolvency, you just are nearly insolvent. That's kind of what the question would be asking, right? So in other words, if you did a forward-looking and the government and they determine they're 12 months from insolvency, you're done. The rebuttable presumption would say, well, you're done unless. In other words, give you the ability to say, well, 90% of the cases, yes, I would be nearly insolvent, but in this one case, I'm not, and here's why. So it does elevate it to Michelle's point. It makes it a higher level criteria, but it doesn't make it ironclad to where there's no out. So to me, the rebuttable assumption was just giving a government ability to say, 99 times out of 100, I'm there. In this one case, I'm not, and here's why. Whereas a weather indicator just makes it be one of the other 15 indicators that we have to look at, which doesn't make it as high of a bar. So I took it as it's not ironclad, and it's not 100% always going to be the answer. And that's what I took rebuttable assumption to be. You could work yourself with your auditor out of it and decide you're not there, but the assumption you start out with is you're there. Does that make sense?
Yes, and
I don't know if that clears it up for you or makes it simpler.
I think it does, and I think so. Basically, it gives you a way to be transparent about the risk, but it's a different level of risk. I think it signals that it's a different level of risk. And I think that's good, as long as that's what it's doing.
Looking for other tents. I don't see any. I just wanted to say thank you for that clarification. Now that resonates for me. That it gives the governments an out if there's an ability to rebut the presumption that's based on the probability assumption that's been applied. So that was helpful. I like where that's going. All right, back to you, Deborah.
All right, so we've alluded to it a bit. The final topic is the question of whether all governments should be required to make a forward-looking assessment. If there are separate disclosures required for it, based on what the board does with question 3, that would already be answered. All governments would have to do it because they'd have to know if they have to make those other disclosures. But if we go one of the other routes, then this would need to be considered whether all governments need to be required to do this. And so question 5, I turned the page too soon. Do you believe all governments should make a forward-looking assessment? Why or why not?
Sam?
Sam Rippin, ASBO International. I guess I'll kick this off. This assumes that there would only be if all governments have to do a forward-looking assessment, which again, I would support, the only disclosure is if they're at risk of insolvency or near insolvency. If the assessment is that they've got more money than they can spend, presumably there wouldn't be a disclosure to that extent. Or maybe there should be at least saying that they're solvent for the foreseeable future. But I don't think it's a bad idea as a practice to review what your solvency looks like, at least for the next reporting period.
Scott?
Scott Deviney, AGA. Yes, there should be no burden here. Auditors are already required to ask for it. Like Dean said, it's an easy answer for almost every government. I think government should be planning and budgeting. And it's parallel to what they need to be doing anyways with MD&A for currently known facts and conditions and for GASB 102.
Rob?
Yes, 100%. They should be disclosing this. I don't know how else to put that. Yeah.
Joel?
Joel Levy, ICI. I agree. We would absolutely love that.
Michelle?
Michelle Waterworth, AICPA. We also concurred that all governments should be making that forward-looking assessment, but we thought if you already are insolvent, not sure there's a point in making that assessment.
All right, seeing no other tents up. Oh, Dave?
So David Goldman, National League of Cities, what would that look like? I mean, would it just be kind of what we already do in the MD&A? Like one sentence, hey, everything's great, or would it require a lot of work and some kind of formula and all, I'm just kind of curious what the burden would be for cities.
And Dave, I don't know if
other
this,
agencies.
Dave, I don't know if it's true here, right? But in my mind, right? Most governments, the vast majority of governments, the overwhelming vast majority of governments, right? They have structurally balanced budgets. They have operating income for their proprietary funds. They have solid, stable revenues. All those things that let 12 months into the future, everything's great. To Dean's point, you're not doing a whole lot to prove that. Everybody can look at the numbers and look at the government, look at the environment and know that. The governments that are maybe not in as good a physical condition, maybe they don't have reserves, maybe they have structural imbalances in their budget, maybe they have operating deficits. They might have to do some analysis, but that's not going to be the vast majority of our governments. Vast majority of our governments. I don't know about Rob, but I don't know how long it take you to do this in Oregon or me to do this in Georgia. I just did it that fast. because you weren't anywhere close. So it's gonna be really quick for most governments.
Bob?
Bob Bland, Association for Budgeting and Financial Management. I like this idea. I think in GASB has, I think, in its basic principles, interperiod equity. That is to say that the funds that are generated in this period pay for the services provided in this period. And when there's a budget imbalance, they're either going to take from the future or from the past in reserves, or some combination of those two, thereby violating that interperiod equity. There's no longer equity. We're living off of either the future or off the past, one or the other. And so I think requiring governments to have a forward-looking assessment and is advisable. This discussion on insolvencies assumes that governments are these integrated wholes, and I think everybody here knows that that's just not the case. I mean, they are made up of all these pockets called funds and fund groups, and there's very tight restrictions on how much money can move across those boundaries. And so what might be insolvent in one fund is not the case in another. But requiring something like this in the MDA, I like that idea better than the notes, that now governments have to require at least look forward in terms of their at least groups of funds, governmental, proprietary to begin with, at least at that level. And how does that look 2 years, 3 years out? How did you balance the budget this year? Was it balanced using current revenues to pay for current expenditures? If not, or if you had to resort to borrowing, now you have a deficit. Now, if that continues for 2, 3, 4 years, you have a structural deficit. And that then is a serious financial problem. And therein, GASB, I think, can have a very forceful place and role in helping navigate governments back to solvency. I mean, that's the goal here. The goal would be no red cars anymore. And I don't think we have, quite frankly, I have not ever discovered a red car yet. But there are lots of green and yellow cars out there. And the more we can provide information up front that exposes that in a way that makes it a public resource, then we have pressure on the decision makers to mitigate those sort of problems and get back to a more balanced budget in which there's interperiod equity. So,
Sean?
Sean Hunstock, APPA. I want to go back to David's question because I think the spirit of that is what are the expectations? You know, when Scott, the auditor, comes and says, have you done a forward-looking assessment? Currently, it's being done as part of the risk assessment questionnaire that happens towards the end of the audit. By including this in a potential GASB statement, are we elevating the level of documentation or recognition that that assessment was being done?
Scott?
I can answer for Washington governments, no. It's what you're doing right now. You may not even realize you're doing it because we're just asking questions. But for Sean and David, they're good governments, so we ask a lot less questions of them than other governments.
So for my group, we didn't have a coalesce around an opinion, but I think for me, as I was looking through the papers, question 2 that gets us back to the forward-looking assessment and the probability threshold. I think in order for that to happen, all governments have to have to do the forward-looking assessment. I think in order for 2 to happen, you need this part on 5. So it kind of made sense to me that, so yes, I would be supportive of all governments conducting the forward-looking assessment. All right, I think that's into the questions. And so thank you, thank you, Deborah, for taking us through the paper. Any final comments? Okay, thank you so much. So we are right back on schedule. So we're going to take a break. So we did it. So let's come back at 2:45. So we'll give you about 18 minutes.
2:40.
240?
240.
Okay, we're cutting you short. 240.
Yeah. To get us back on.
Oh, you're right.
Yeah.
All right. So next up on the agenda, we have the implementation guidance update, and I'll turn over to Robert Scott to introduce the topic.
Thank you, Rob. The purpose of this project is to update implementation guidance, which, as you all know, is Category B gap, for additional issues that come to the attention of the staff. And the specific topic, and the only topic of this proposed implementation guide, relates to the issuance of a guide to provide authoritative questions and answers related to the implementation of the definition of subsidies, which was defined clearly in Statement 103. And at our February meeting, the board cleared for issuance an exposure draft, a solicited comment from stakeholders. That comment period concluded on April 27th, 2026. We received 94 comment letters, which included 17 form letters. Based on that feedback, the project staff is proposing modifications to certain proposals in the Q&A that was in the exposure draft. We're here today to get your feedback on those proposed modifications. The board will be discussing the modifications as proposed by staff later this week. And based on the current technical plan, we would see pre-ballot and ballot drafts at our August and September board meetings. And if the proposals move forward, an issuance of a final implementation guidance document would be scheduled to be cleared by the board in September. So this is your last opportunity to provide feedback on this topic. So Lisa?
Thank you very much, Robert. And as Robert said, we received just a few respondents providing feedback on the implementation guide update. So we're going to take you through question by question and at a very high level summarize for you why the staff is making the proposed modifications to the board on Wednesday that they are. And then I'll open it up for discussion on those questions. We'll take them one at a time. Well, in one case, we'll take them two at a time. And Roberta and I are going to tag team this. I'll do one, she'll do one, and then we'll basically go back and forth. So let's start off first with question 4.1. So 4.1 was the question related to supplemental Medicaid payments and whether or not they would in fact meet the definition of a subsidy. We got some respondents to the exposure draft that agreed with the proposal in the exposure draft that this would in fact be a subsidy for the reasons that we had proposed. But there were many that had provided some concerns and disagreement with the proposals in the exposure draft related to this Q&A. So in the end, and I should have started off also by saying, hopefully you had the opportunity to take a look at attachment B, because attachment B was the very short 56-page paper that the board was receiving as part of their package for their redeliberations on these Q&As on Wednesday. So that would have given you the full picture of the staff analysis of why we were making these recommendations. But in the end, with this one, the staff really found two compelling arguments that we heard from the respondent feedback. The first one was, hey, you're actively deliberating a project related to revenue and expense recognition, which that project in and of itself may clarify some of these issues related to supplemental Medicaid payments, which really at the end of the day came down to, is it one transaction or is it two transactions? Right? And so we found that very compelling. The second one was that there is a tremendous amount of variability in supplemental payments that exist. And so this could create some inconsistency in the application to how governments apply the Q&A in their specific situations. So as a result of those two things, we really felt that this issue may be more appropriately considered after the completion of the current revenue and expense recognition project. So as a result of that, we are proposing to remove question 4.1 and its related answer from a final implementation guide. So with that, let me pose GASAC discussion question number 1, which is what feedback, if any, do you have about the project staff's proposal to not carry forward proposed question 4.1 to a final implementation guide?
Feedback for Lisa? Darren?
Darren Tarleton, HFMA. You'll be surprised to know that we are strongly supportive of the staff's proposal here and appreciate the constructive dialogue and liaison meetings and taking into account some of the feedback that you received. But for the reasons spelled out here and also in the HFMA's comment letter, we do agree with removing this from the implementation guide update. Thank you.
Dean?
Dean Mead, NFMA. Just to clarify, our organization doesn't have very much interest in this type of guidance. They're not the primary audience for it. So most of what I'm saying here is me. But for me, I am grateful you dropped this question. I think there are a lot of hospitals that report these payments as operating revenue right now. And if the whole surplus idea originally was to pull up some of those things that were down in non-operating and put them above a new measure, taking something and moving it in the opposite direction is, not going to be popular. And so I'm glad to hear that at least for the time being, nothing's going to happen there. And from the NFMA's perspective, the only thing we really care about is that the results of this guidance is that everybody's doing things the same way and not really vested in whether the answer is A or B, but that everybody's either doing A or B.
Anita?
Anita Kovacs Nakubo. We support this recommendation because Nakubo did write a objection to 4.1, and this will really help the universities that have hospitals to keep that revenue in the operating section.
Michelle?
Michelle Waterworth, AICPA. First, just wanted to thank you for all of the effort that you did in terms of going through all those various comment letters and really paying attention. Not that you don't always do that anyways, but just wanted to acknowledge the, I'm sure, extra effort that it took, given you had so many comment letters. We absolutely agree that it should be removed, so appreciate the decision on this one.
Rob Hamilton, NASAC, we were also in agreement with removing of this question. All right, back to you, Lisa.
Excellent. I'm going to pass it over to Roberta for 4.2 and 4.3.
Okay, 4.2 and 4.3. So these series of questions are in the higher education space, also received a lot of feedback in our comment letters. There was something, it raised actually, as if you read our larger paper to the board, it raised additional issues about the higher ed space. And as our IG expert, Emily, can attest, we can't answer additional questions in the IG because we haven't exposed those questions. It is something, if you read that additional paper, you see we've discussed more thoroughly some of the reporting issues associated with higher ed. What we have done is try to focus the question more clearly. I think some of the language that we used in the exposure draft more closely, we had the phrase donations for scholarships. I think we were mixing up two types of transactions, and that was what a lot of our feedback was about that. So the edits, we didn't change anything about the answer. We tried to explain it more clearly, what's going on, and we added more of the whys. That was something else that was commented on. So we're making it clearer that we're focusing more on this idea of donations. Donations turn into subsidies, and we're explaining why the donations meet the definition of subsidies. We're explaining more about how in the higher ed space, those two criterion, especially the second criterion, is met in this certain circumstance. In the higher ed space, the idea of scholarships being awarded and what is reported as tuition fees. We have to understand how that works in that particular area, and what is meant by the criterion 14A2 is the net revenue and not the gross revenue. So hopefully we've tried to convey that in these questions. In both cases, the other thing that we highlighted in the paper, and that was something that was mentioned in several of the letters and the feedback that received, had to do with Pell Grants. It was noted in the codification instructions to 103 that we had an existing question related to Pell Grants specific to higher ed, and it was related to a different issue with a side note of how Pell Grant revenue was classified, and that was changed from non-operating to operating. They didn't, stakeholders indicated they didn't understand why that was reported as operating. We didn't really have an opportunity to change that related to that. So they were kind of understanding why, like, scholarships, donations for scholarships might be different, internal our discussions in which we would use to support responding to any inquiries. Not any inquiries, the many inquiries that we have received. We've discussed this idea of portability and the attachment when the resources come to the university. Are the resources donated to the university or the resources attached to the student? Something like the Pell Grant, while it comes to the university administers, it's associated with the student and is portable for the student. So it goes to the institution that the student chooses, and that's the key with the Pell Grant issue. So with that, I will ask question 2, what feedback, if any, do you have about the proposed modifications to questions 4.2 and 4.3?
Feedback for Roberta. Anita?
Anita Kovacs Nakubo. We do agree with the responses to the questions. However, the whole wordage using, published rates demonstrate the tuition and other charges that would be needed in absence of the donations. I think I talked to Alan about this a little bit. We also are funded with huge amounts of government subsidies. In the state of Florida, we've not raised tuition rates for 13 years. So that means that the state is paying all of that difference. And so when we were reading this, and as we were trying to make a lot of determinations with the implementation of GASB 103, when all of the questions were phrased in, well, if it has to be an increase to future tuition, I was the main person driving that implementation. And I said, well, you have to pretend like you have a choice of whether you can raise tuition rates or not. If you raise tuition rates, you get a call from the governor in our state, and you're told that you will not get anything for your institution from the state. So you generally do not raise rates. And this kind of makes it feel like the only two sources of revenue that primarily fund an institution are the tuition rates and the whatever donations you get. And that would work for a private institution, but for a government-funded college or university, the state of Florida is paying 40 to 50% for everything that we do. So we need to acknowledge that the government subsidy is huge. So that's my feedback.
Thank you. We should clarify that's not the only source of subsidies. We can do that. Thank you.
Scott?
Scott Deviney, AGA. For question 1, the group was like, agree, thank you. For question 2, group continues to have mixed views on the logic behind it, but I just want to say, personally, I'm just very happy to have a definitive answer. Thank you very much.
Seeing none, back to you, Roberta and Lisa.
All right. So that brings us to question 4.4. 4.4 was the question related to research grants received again by a higher education institution and whether or not they in fact meet the definition of subsidies. Important to note here that some respondents did agree with the proposed question and answer in the exposure draft, and of course others certainly did disagree. I think one of the big areas of confusion here is that this one specific question in the exposure draft only focused on one of the 2 criteria in Statement 103 as to whether or not something is in fact a subsidy. It was really focused in on the second criteria of does it keep current or future tuition and other charges lower than it would be otherwise. It wasn't focusing in on the idea of whether or not the provider was receiving a good or service in return. But nonetheless, I mean, the question did say that it was focused on that one criteria. But many people, I think, lost sight of that. And partly it's because all of the other questions asked, is it a subsidy? So why would this one be different, right? But it was. So we acknowledge that that created some confusion. And you can see in the proposed amendments here, what we're doing is that we're proposing to expand that so that the question is like the others, and it does take into consideration that first criteria of whether the provider is in fact receiving a good or service. We heard from many that a lot of research grants do in fact have that good or service, a patent or something being provided in return, which we were aware of. So we kind of thought that first criterion was a slam dunk. But we're proposing to bring that back into the fold here. We're also proposing to remove what many respondents called a hypothetical, right? So this would be the language that we had proposed of something existing in the absence of the grant. So we're now proposing to remove those hypotheticals in the answer. And we're also really making a push here that professional judgment is going to be a big player when you're making that determination of whether it does in fact keep the tuition or other charges lower than they would be otherwise. So with that, let me open up question number 3, which is what feedback, if any, do you have about the proposed modifications to question 4.4?
Feedback for Lisa? For Rob Hamilton with NASDAQ, we were supportive of the change, so we appreciated that the change was made. Scott?
Scott Deviney, AGA. Yeah, much better. Thank you very much. Personally, the only way to make it better would just be to make the bright line brighter and just say they're not subsidies. I can't imagine a situation in practice where I'd consider them to be a subsidy, but great. Thank you.
Dean?
Dean Mead, NFMA. I think this is a significant improvement over the prior version of it, both in that it acknowledges that there is a substantial number of these research grants that do involve the provision of goods or services either to the grantor or at the direction of the grantor. Neither one of which would, in my opinion, qualify as non-operating at all, let alone a subsidy. And also, makes clear that that the university is going to need to use its professional judgment with respect to the second criterion. And I'm kind of in the same boat as Scott. My experience has been, that grantors are not in the practice of saying, sure, go ahead and use this money wherever you want. That they kind of expect with maybe an overhead portion that you're going to spend it on the thing they ask you to spend it on. So I'm very grateful for these changes. Thank you.
Michelle?
Michelle Waterworth, AICPA. Yeah, we absolutely also agree and appreciate the acknowledgement that a research grant could be an exchange transaction. One recommendation we had is that the paper talks about the fact that for purposes of the standard, the presentation of operating and non-operating, bifurcating a grant is not required. It'd be great to see that incorporated as part of the guidance.
Other feedback? Seeing none, back to you, Lisa and Roberta.
Okay, my turn. Question 4.5 is on taxes that are taxes imposed or reported by a BTA. We had feedback that was both supportive and disagreed. We generally, some of it had to do a little bit with the use of the term tax. I think we have another question in here in the prior implementation guide on pilots where I think maybe we have several of these where their use of a particular term, someone comes up with an example of here's something that's called this and it doesn't fit your situation very well. And I think that's the case here, that the term tax, sometimes that label is applied to a circumstance that that we weren't anticipating was a typical tax, that is really something that's more like a fee for service. There was a suggestion that we went with this idea that in our literature, we do have language for, we ended up changing the question to refer specifically to our guidance and the specific language of derived tax revenues and imposed non-exchange transactions in our statement 33 to make it clear what we mean by the term taxes rather than using this specific label that may be associated with the particular transaction. We think that clarifies it. And then the other thing we're trying to clarify, that it is limits the question and answer to circumstances in which the BTA is imposing the tax. If it's coming from a different organization, it wouldn't be reported as a tax to begin with, so that wouldn't apply to this situation. So with that, I'll pose question 4. What feedback, if any, do you have on the proposed modifications to question 4.5?
Feedback for Roberta? Stephen?
Stephen Stewart, Governmental Research Association. We just wanted to say we don't have any concerns about the changes, that we appreciate the clarity.
So Rob Hamilton, GASAC, I think, I know it was addressed on, I think it was page 49 of Appendix B around the use of the word directly. I think that's still one that we're a little bit struggling with because everything else is pretty well verbatim in terms of the different criteria, and directly is inserted. And I know that, you know, is explained in the paragraph, again, on, I think it's page 49. I think that's just where I think where we were struggling with it is everything else is the same, but then that word is inserted as if it creates a new evaluation by which to consider whether this is a subsidy or not. So that's just an area that I think we're still kind of wrestling with. So just for Scott.
Oh, Scott Davini, AGA. I was going to say about the same. Yeah, better. Thanks. I'm not suggesting taking this out of the AG, the IG, please don't. But I do think it would be helpful if directly was added to the standard in a future omnibus project, maybe with some of those items that we were supportive of in the last implementation guide that got taken out. Because I think it would be better at the top level gap. But don't change anything for now. Like with the implementation guide, we just want the answer. Thanks.
Dean?
Dean Mead, NFMA. I appreciate the clarifications you guys have made here, but I don't think any of them address what I find to be the principal conceptual problem with this, which is the notion that governments can self-subsidize. I don't see how a governmental entity can, subsidize one of its revenues with another revenue. This is the choice, of revenue streams that are available to these entities. There are plenty of them in Florida, for instance, utilities that are partially funded with a property tax and partially funded with their water and sewer charges. And the notion that one of those is subsidizing the other, I find to be odd, to say the least. This is how they were created. And they're almost always the same exact people. They have 10,000 customers, and most of them are the same people who are paying the property taxes either directly as property owners or indirectly through their rent as renters. And so who are they subsidizing? If you can get around the notion that there are 10,000 property taxpayers and each one of them is individually subsidizing the water and sewer rates that are being paid by the customers, which happen to be pretty much the same exact people. What subsidy is actually taking place here? I don't see it. I don't see it economically, and I don't understand how, tax revenues that the government is imposing itself can be a subsidy for other revenues that it's imposing. That just seems to be the mix of revenues that they've chosen to finance their entity, and not an idea that somebody's getting a break because we're paying for some of what we do with property taxes rather than charging them for water and sewer.
Other feedback? Bob?
Bob Scott, GFOA. Dean, I kind of disagree with you. Actually, not kind of. I do disagree with you. The reality is many of us have a whole lot of tax exempt entities in our jurisdictions. In fact, many will have a very large university or other things where a significant amount of the property is tax exempt. So if you require water rates to be reduced by taxes that are only paid by a small, or not even small, but by a percentage of the water customers, then it is a subsidy. I mean, that's one of the dilemmas I've seen over the years is you have a big university town and maybe they have some state offices also, and it's this vibrant economy, and yet they have no taxes to provide basic city services. And so I do see that as a subsidy.
Dave?
I was actually going to say some of what Bob just said, that, people who are just paying the regular property taxes might not get a direct, they might get an indirect benefit from it, but they don't get a direct benefit from it because they don't receive the goods and services directly. So it can be seen as a subsidy in that case.
All right, back to you, Lisa and Roberta.
Okay, thank you. Question 4.6 is on passenger facility charges. This is one where, again, we had mixed feedback, supporting and not supporting. Again, in the analysis, we still believe that the way we have described the situation and the question and answer does represent the essence of the transaction. We did a little modification to try to make it clear what the arrangement is in the situation, that the airlines are the customers of the airports, and the passenger facility charges are in essence a tax on the passengers that are the customers of the airlines, trying to get that relationship, which, for many of the people that are, travelers, that if you haven't been involved in airports, specifically auditing airports or preparing financial statements for airports, that may not be the first thought of how what those relationships are. So we tried to make that clearer in the question and answer just by emphasizing passengers versus parties and things of that nature. So with that, I'll pose question 5. What feedback, if any, do you have on the proposed modifications to question 4.6?
Abel?
Abel Palacios, ACI. I know I was shocked if anybody else has a comment on this question, but I'd welcome it. Thank you for giving me the opportunity to speak. We prefer, instead of the word tax, a user fee. I know at our airports, we pride ourselves in saying we don't impose taxes. So the PFC is considered a user fee from the FAA standpoint. So that point of clarification. PFC, we collect PFCs, and I'd propose some modifications on this response. If I could read what the proposal I'd recommend. Passenger facility charges, similar to user fees or taxes discussed on question 4.5A. passenger facility charges are imposed on passengers and meet the definition of subsidies because they are received from the airlines but paid by the passengers, and end that with that section of A because the passengers do receive benefit of the goods and services. They pay for eligible PFC projects or capital projects. Terminal is an example of that. So it's a direct benefit to the flying public. So we'd ask that that part be eliminated out. And then on B, allow the airport to directly or indirectly keep and apply to future fees and charges and leave it at that. I'm not happy with the word concessionaires on there. It certainly implies that concessionaires will receive a benefit, and that's not necessarily true, and I don't want to open that up to our concessionaire population. If anything, I propose increases in PFCs, and we advocate for that each and every year with the FAA.
Maybe we could ask you to provide us that language specifically.
Absolutely.
We weren't able to write all of it.
Be happy to do that.
Scott?
Scott Davini, AGA. No, I mean, I know PFCs.
All right.
But I'll defer to Abel on all of that. I think our group was still had mixed views on the logic, similar to question 2. But ultimately, just happy to get a definitive answer. I think Dean had articulated it well of like the number one is where should these things go? And if we know, then we get consistency. But yeah, defer to Abel on all of the language for that because I don't know if we could have come up with that.
Rob Hamilton, NASAC is just the use of the word directly in the response again, similar to the previous answer. All right. Back to you, Lisa and Roberta.
All right. I don't know about you, but once I get through 4.6, I go, phew, I can breathe. Because 4.7, 4.8, and 5.1, generally respondents agreed with what we had proposed in the exposure draft. But nonetheless, let's take them one at a time. So question 4.7 really was aiming to get at how subsidies other than those that are non-capital subsidies should be reported. And you can see here what we've proposed is to include reference to paragraphs 11 and 12 of Statement 103, which is where we discuss and describe how non-capital subsidies should be presented. We got some feedback related to that would be helpful. So we're proposing to add that. So with that, I'll open up question 6. What feedback, if any, do you have about the proposed modifications to question 4.7?
Abel, do you have one on this? Okay. Dean? Go for it, Dean.
Sorry, I was so fascinated by Abel's card being up. I think this answer is fine. I thought it was implicit in the in the statement that there was nowhere else for it to go. But the one thing I would ask is that in the answer, since the question is how should they be reported, in the answer I would strike are capital subsidies and. The question is not what are they called, and capital subsidies is not a thing in 103 to the best of my knowledge. I did a search and the word capital doesn't show up anywhere in the document, so except as part of non-capital. So I would ask that don't create a new, especially in category B gap, don't create a new name for these subsidies. They're just not non-capital subsidies, and otherwise the answer that would be left if you took that part out still answers the question directly. Belt and suspenders is always welcome.
Scott?
Scott Davini, AGA. I'll just answer question 6 and 7. Agree. Thanks for the edits. And just echo Michelle's comment, just appreciating GASB's work to try to make these as clear as possible.
Rob Hamilton, NASAC, we were supportive of the change for question 4.7. Seeing no other tents up, I will turn it back over to you.
All right, thank you very much. That brings us to question 4.8, which was getting at how a BTA should classify subsidies received if the provider of the resources limits the use of those resources specifically to debt service for capital-related debt. As I said up front, respondents generally agreed with this. We are proposing just a few slight wording modifications here, really to pack the point that in this case, this question is focusing on when the BTA or the enterprise fund is receiving the subsidy, not when they're acting as a provider of the subsidy. So we just wanted to make sure we were being very clear about that. So with that, I'll open up discussion question 7, which is what feedback, if any, do you have about the proposed modifications to question 4.8?
Feedback? Dean?
I just actually wanted to ask a question about this based on the edits here. So you're convinced this could never be an internal service fund? Because otherwise, the provisions, as you guys know, apply to the proprietary funds, and that's the language you use in the preceding question. But this one is specifically only looking at BTAs and enterprise funds. Yeah, it's just a question to think about. Is this proprietary funds, or is there reason to believe that internal service funds would never have this issue?
Any other comments? All right, seeing none, back to you, Lisa and Roberta.
All right, so that brings us to the last question within this paper, which is question 8. What other feedback, if any, do you have about the proposals included in the exposure draft?
Scott?
Yeah, Scott Davini, AGA. I just think in general, the definition is very hard to apply and hard to follow the logic and analogize even from the IG questions. And I think that's reflected in the extent of comments. I don't know what the solution is. I can't give you a better definition. I think that ultimately it leads to the risk of inconsistency in practice. The solution that I would suggest is like the more IG questions, the better. So as you're getting the TI questions, I know our office is just submitting a list of them. It would be helpful if you can, put out some additional ones in the future with those answers. Because again, I think that it would go a long ways for consistency of this standard. Thanks.
Rob Hamilton, NASDAQ. I would echo Scott's comments. I know that the staff and the board are always looking for good items to include in the implementation guide if they're like a next update. I suspect there will be some questions that will be coming. This is a fairly significant change for some governments, and so just supportive of that effort. And I know that the board will and the staff will. And I also wanted to just echo the comments of Michelle and Scott. Appreciative of all the work on this with working through the questions and answers and being responsive to the feedback. So just wanted to acknowledge that as well. All right. So thank you for your work on this. Any other items on this before the council?
No.
Okay.
Thank you very much for your feedback.
All right. The next item on the agenda is the pension and OPEB disclosures, concept statement 7, and the pre-agenda research associated with that. And I'll turn it over to Diane to introduce the topic.
Thank you, Rob. I got the short straw this time. So this is research that the board has approved for statement 67, 68, and 75 for pensions and OPEB. These were all released before concept statement 7, and I know you all can quote it by memory, but I'll just remind you that concept statement 7 is the guide that the board uses to determine disclosures being essential, and it's referencing the user's use of the disclosure. So what this research is proposing and what staff is working on is that they want to go back and look at the pension and OPEB, all of the disclosures, and measure it against concept statement 7, which is a huge project, and I'm going to turn it over to staff.
Awesome. Thank you so much, Diane. And yes, as Diane said, we are going to go through the camera lens of concept statement 7 with the pension and the OPEB note disclosures. Diane talked about this new criteria, right? This higher essentiality threshold that concept statement 7 brought to light for note disclosures. And basically what that means is it's a two-part kind of test, right? So the first thing we ask ourselves is this information used or would it be used by a breadth or depth of users? And then the second criteria is, hey, not only do you have to use it, but are you using it in a meaningful way in the decisions that you're making or the assessments of accountability that you're making in regards to that government? So when we talk about this concept statement 7 lens, it's those two criteria basically that we are talking about. So where have we been and what have we already done here? Well, if my clicker will work, I can show you. Sorry, guys. Why is it not advancing?
Agree with that. Or this.
It's not advancing. Oh, here comes Colin to the rescue. I could talk about this without the slides, but I'm sure you'd prefer excellent. All right, so what have we accomplished so far? Well, really, when we started thinking about this research, right, as Diane said, this is a ginormous project. And I tend to think, before I even got started, if I would have said to all of you, when you look at your ACFRs or the ACFR of the governments that you analyze, what is the single largest real estate in the note disclosures? I tend to think that you all would have said the pension and the OPEB note disclosures, right? So you can imagine the scope of this and what we're looking at to try to determine, does every individual item of information that's required in those note disclosures meet this higher threshold of essentiality? Because concept statement 7 says you can't look at this broadly. You got to look at it for every individual piece of information. So what we did is we said, okay, first we're going to go out to users, broadly put it out there for users with a really quick, easy survey for them to answer, because we recognize our users are super busy. But what we wanted to get out of that first survey was, do you use broadly the information in the pension and the OPEB note disclosures? So that was what we did in the first survey. That's been conducted, completed, and I'm going to show you what we learned from that first survey in just a minute. The second piece was, okay, we need to wrap our arms around these disclosures. We knew there were 6 codification sections that had pension disclosures, 6 codification sections that had OPEB disclosures. And remember, we're looking for those individual information items that are required. So I'm really excited. I think we came up with an awesome way to catalog and identify individual, unique disclosures across all of those codification sections for both pensions and OPEB. And again, I will show you what I mean by that in just a minute. The second survey was, okay, survey 1 participants, those of you that said you use the information, we also asked you, would you be willing to participate in further research efforts? So all of those people that we hooked that said, yes, sign me up, I'll participate in further efforts, they participated in survey 2, where we said, all right, you told us you use this information, but what do you use to make your decision or your assessment of accountability? We've completed that survey, and I'll show you what we learned from that as well in just a minute. The final step is where we're really going to roll our sleeves up with the people that completed the second survey, and we're going to say, okay, how do you use it? Right? So when you think about our essentiality criteria, breadth or depth, we're getting that with survey 1, right? Do you use? And then this whole idea of meaningful effect, we're going to get in the interview process when we're talking one-on-one with people to get at how do they exactly use this information. That's going to arm the team so well to then be able to go back to the board and inform the board so that they can make some decisions around, do these individual information items actually meet the essentiality criteria in concept statement 7? All right, so let's talk about survey one. But before we do that, just to give you a little snapshot of what our timeline looked like, we started this process in May of 2025, and I'm happy to report that I feel pretty excited that we are on track, that we will be able to provide the board with a research memorandum that summarizes all of our research by the end of this year. What I will tell you is that today, although we have completed certain parts of this pre-agenda research, and you're going to see some of those results, we haven't yet looked at it all in totality, right, to really draw some concrete analyses. So just keep that in mind as I'm reporting back to you as to what we've learned thus far. All right, so survey one, do you use the information? We put this out broadly to all users in our CRM constituent database. For this one, we actually use the FAF user database as well. So that reached a larger group of users. And right out of the gate, respondents, we had about 124 users that actually responded to the survey. But you can see we whittle that down to what we call 52 good survey responses. And that's because some of them, 33, basically were not really a user. They answered the survey, but really when we looked at it, they weren't a user. And some of them actually said, hey, I'm a user, but I'm not really that interested in the government space. So to us, that information was not necessarily pertinent to the work that we were doing. So that brought us down to 91. Then in that survey, one of the lead-off questions we asked them, of course, was whether or not they were interested in pension and OPEB. If they said no to that, well, we knew we could take them out of our sample as well. So we got rid of another 21 that brought us down to 17. And then our last microscope was when we asked them broadly how they used that information. If they gave us something that was not a decision or not an assessment of accountability, then we remove them from our sample as well. Because remember, that criteria, right, has to have a meaningful effect in their decision-making or their assessments of accountability. All of that to say, at the end of the day, we ended up with 52 good survey responses that we used for this purpose. And you can see a real good range of user types in that first survey. The biggest group were our bond market participants, at 20, which was, very, very healthy. That's almost 40% of the total. And then you can see pretty well academics and then legislative oversight people, research organization analysts, and then an other type of user. These were like our citizens or our union representatives that would fall within that other category. So broadly, we said to them, okay, what types of post-employment benefit information do you use? Because you might be interested in pension information or OPEB information or both. And you can see here the majority of the 52 people said that they were interested in information for both pensions and OPEB. And when I say majority, it was an overwhelming majority with 49 of the 52 people. So then we said to them, okay, where do you go for this information, right? Do you go to the basic statements? Do you go to the notes? Do you go to RSI? And surprisingly, you can see that for both pensions and OPEB, the winner was notes to the financial statements. But honestly, the basic statements and RSI, pretty close right there with the notes, meaning it was pretty equally spread. And also important to note, based on those numbers, that some people said they went to more than one place for that information, which is why it doesn't add to 52. We then said, okay, what parts of the plan financial reports do you go to for this information? The prior slide, if I didn't say that clearly, was the employer financial statements. This is for the plan financial statements. And again, you can see the winner here was the notes, but here as well, right there were the basic statements and RSI. So then we said in that first survey, okay, give us the reasons or how you use this post-employment benefit information specifically in the notes to the financial statements. So this is where, quite honestly, we were trying to set ourselves up for the second survey because we wanted to be able to tailor questions in that second survey based on the type of decision or the assessment of accountability that they made. And you can see we basically narrowed it down to you're making investment decisions or assisting in the investment decisions of others. You're making or you're recommending legislative decisions related to funding or oversight of that employer government, or you're using that information to assess the accountability of that employer or of that plan. The top two we got as responses. So some said, hey, we use it just to gain an understanding of the reporting government or the plan, or we use it for research, for benchmarking purposes. Well, that's not directly a decision or an assessment, right? So in those cases, we really tried to narrow them down into something that was actually a decision or an assessment of accountability. All right. So as I said up front, after that first survey, we asked those 52 people as well, would you be interested in participating in further research efforts? Those 52 said they would. So when we sent out the second survey, targeted them, 29 of those 52 actually came back and said, yes, we would be interested in continuing on with your research efforts. Would I have liked that to have been a little higher? Yes, I think Tammy maybe she always tells me, no, that's good. We got 55% representation. And we feel like the thing I want to stress is that we have great representation amongst all types of users within the bond market, the legislative folks, the academics, and certain other types of users. So we really felt like we had a good representation of voices here in this second survey. As we were developing the second survey and when that first survey was out, we were going through that step 2 that I talked to you about, which was huge task that we went through to try to identify unique disclosures. Because think about it, at the end of the day, we knew we couldn't go out to users in a second survey with 1,099 disclosures, right? We couldn't talk about that many disclosures in an interview. So we were trying to find a way, recognizing that there's a lot of duplication in the disclosures that are required within pension and OPEB and the different types of plans and whether they're trusted, whether they're not, whether they're DB, whether they're DC. There's a lot of duplication in requirements across those 12 codification sections. So this was our way to try to distill it down to bite-size information that we could then bring to the users in the second survey and, of course, in our final interview step. This slide is an awesome slide, guys. So this, you know when they say a picture tells 1,000 words? This breaks down almost a year's worth of cataloging activity that we went through to try to get to this bite-sized information. And so you can see when we started, right? 6 pension cod sections, 6 OPEB cod sections. So step 1 was, hey, we need to go in and we need to extract all the subparagraphs from the codification that specifically contain disclosure requirements. So for pensions, that was 197 subparagraphs that had disclosure requirements. For OPEB, it was 218 subparagraphs. Then we said, okay, in step 2, we need to now identify within each of those subparagraphs each specific individual item of information that's required in those disclosures. For pensions, there was 526 individual information items that we identified. For OPEB, there was 573. That's 1,099 individual disclosure items within those 12 codification sections. So now the fun begins because now we're trying to chunk it up, right? So step 3 is where we said, okay, we need to collapse that 1,099 of individual items into items that relate to distinct disclosures within each codification section. So this was where we removed the duplication within pensions for those 6 sections, within OPEB for those 6 sections. So that brought us down to 228 items for pensions and 248 items for OPEB. Step 4 was, okay, let's do a little more collapsing. Let's now collapse the information items to distinct items for pensions and distinct items for OPEB. And that's where we got to 111 for pension, 117 for OPEB. And the last step was, let's find the unique ones. So let's remove the duplication between pensions and OPEB, because we know, right, that the OPEB standards very similar to the pension standards. And so by doing that, we were able to get ourselves down to 119 unique individual information items, 2 that related to just pensions, 109 that related to both, and 8 that related to just OPEB. So remember where we started, right? We started with 1,099. We got ourselves down to 119, which seemed a whole lot more palatable when we were going out to stakeholders. And you can see how we did this. So we then identified 9 unique categories and 30 unique subcategories for those 119 individual disclosure items. And so you can see them here, right? The categories were things like plan description, PEB liability, discount rate, PEB expense, right? Those types of things. We got them down to 9 and then 30 subcategories. And you can see the unique item count for each of those 30 subcategories. This is important because in survey 2, we asked users about the information at that category level. Because in a survey, we're promising them, hey guys, bite the bullet, do this survey for us. It's only going to take you no more than 10 minutes. We felt pretty comfortable with 9 categories of information that we could at least narrow the funnel for the interview process and get them to tell us where are the categories of information that they use to make decisions or assess accountability. And so that's exactly what we did. Survey 2 said, what information do you use of those 9 categories of information? And you can see we had 29 that said, yeah, I'm going on this journey with you, Parker. We will continue on. But at the end of the day, only 21 then completed survey 2. Okay, but I don't want to sound like a Debbie Downer. It's yay, 21. It's not only 21 because that was 75% of our sample. And again, it's a really great representation of all of GASB's user types. All right, so what did we learn in survey 2? So remember, we kind of chunked this up at that category level, and you can see here that the vast majority of cases, the respondents or the survey participants told us when it came to PEB information that they used these broad categories and subcategories of information for both pension and OPEB. You see the outliers there? There's 2 in the middle, the assumptions used in the alternative measurement method, the healthcare sensitivity analysis, and then at the very bottom, the deferred retirement option programs, DROP, better known as DROPs, which of course are only applicable to pensions. In those cases, they said the large majority of the respondents said that they didn't use that information for either pensions or for OPEB. And so then we asked about location. Okay, where are you getting this information? Are you getting it in the notes to your employer statements? Are you getting it in the notes to your plan statements? Or are you getting it in both? And you can see in this case, it's, the top plan description, liability, discount rate, measurement other than the discount rate. they're primarily getting it in both, but in the majority of the cases, it's pretty much the notes to the employer statements. And then you can see, of course, the plan financial information. Of course, all that responded said they were getting it in the notes to the plan financial statements. So then we asked, okay, what about the location of the categories that are present in both plan and employer financial statements? And this was for OPEBs only. And you can see here, pretty much same type of deal, right? Where description, liability, discount rate, those things, they're going to both places, or the notes predominantly to the employer statements. And it's only the plan financial information where they're predominantly going to the notes to the plan statements, just as one would expect. So where does that leave us? That leaves us with one last exercise to conduct before we start writing the final research memorandum for the board, which are the interviews. So as I mentioned up front, these interviews are going to be a 1-hour interview with 20 of the 21 people that completed survey 2. And we are really going to roll up our sleeves. We've already secured times the whole second and third week of July. All the interviews are scheduled. We have provided them some customized advanced materials where, based on their responses of what they use, that is where we're going to be drilling down as to how they use it. Because remember, we have to be able to inform the board on meaningful effect. So it's not just, oh yeah, I use it. It's like, we need to know how you use it. How does that impact your decision so that we can then bring it to the board so that they can make a determination around meaningful effect. And so we will be conducting these interviews very shortly. July and September, we will then begin the process of analyzing and really putting together the results from all of the different activities so that we can prepare a final research memorandum. And as I mentioned up front as well, we are on track to be able to present that memorandum to the board by the end of the calendar year at their December board meeting. So with that, I want to open up the one question that was in this paper to you, which, well, there was actually 2 questions. So let me pose the first question. Is there anything in this interim update, because we're not done, so is there anything in this interim update that surprised you and why?
Feedback for Tammy and Lisa. Sean?
This may have been outside of the scope of the project, but I was surprised to not see constituents or elected officials included in the type of survey respondents.
Oh, no, they are, Sean. Legislative, we do have legislative representation. For sure.
Dean?
Dean Mead, NFMA, at the risk of, ending this meeting on a downer, we don't like this research for a variety of reasons. One is that unlike any other research activity I can remember, there's only one possible outcome here, and that's to reduce the amount of disclosure. No consideration of whether there are unmet disclosure needs. All that can happen here, the best that the users can hope for, is that nothing is taken away. I think it also ignores the context in which users are employing the information that's in notes. Many pension and OPEB note disclosures are very poorly written and very badly organized. And it's been 10 years. We've got 10 years worth of pension information and 7 or 8 years worth of OPEB information and very little evidence that any governments have gone back and rethought how they present that information. Very little evidence that there have been any improvements in how the information is presented. And one of the reasons why those disclosures are so long is because governments have essentially, if they're in 3 plans, they've done the full set of disclosures 3 times, back to back to back. without any thought about how that could be consolidated and presented in a manner that would be more useful to the users of those disclosures. And so I don't know how you can consider the essentiality of this information and the answers that you're getting from users without taking into account that they're not working with, GASB illustration quality disclosures. And that clearly is going to affect the usefulness of the information. I also think that your decision about what your narrowing of the definition of what constitutes a decision is puzzling to me. There's very little research that or work that uses financial statement information that's done for the heck of it, just to contribute to the knowledge of society. Most people don't have the time or ability to just do the work because it's fun to do and it's interesting to know. Even the most pure academic studies are trying to answer a question, and generally something that they believe to be relevant to the real world, so that something can be done with that research, and including benchmarking, for instance. Why would they benchmark if there wasn't something they were trying to determine? And a pure evaluation of whether a government is in good financial health, is a decision. They're drawing conclusions based on the information. They're deciding, are they in good health or are they in bad health? Not every decision is, do I buy a bond? Where do I live? Who do I vote for? They're not all that consequential. And so I've seen very little examples over the years from all parts of the user community of research that is just done, because it's a valuable contribution to the general knowledge. And then lastly, I don't see how you can make any decisions about essentiality based upon 21 respondents, only 9 of whom are bond analysts. These requirements are here as the result of hundreds of users participating in the research that led up to the project being added to the agenda, and then dozens more responding to 3 rounds of due process. And the notion that 21 people could, no matter what they say, counterweight that type of input that led to the requirements in the first place, I find astonishing. There are way too few people that are providing input on this project, and I just don't know what else to say about that. It keeps getting, that list kept getting narrower and narrower and narrower, and it doesn't matter that it's 21 out of 29 people. It's 21 out of the thousands of people who use financial statement information on a regular basis, and that can't be the foundation on which the board makes a decision about whether something is essential.
So I know project is, or sorry, Tim, yes.
Yeah, I'd like to respond to a couple of the points that Dean made. The first is that I would respond to the question about decisions and what the users had in the survey, that where we were trying to differentiate between whether they were making a decision or assessing accountability versus just using it more broadly, that question was posed in a manner that allowed them to answer multiple ways that they might use that information. So it wasn't that we were looking at that to say if they just use it for general information, that wasn't really enough. It was accompanied by a companion, hopefully, of you're using it to make a decision, you're assisting your bond market analyst, rating analyst, and you're helping in those decisions. It's not that that particular information item has to move the needle entirely on its own, just that it's used somewhere in the decision process for that particular user. The other thing I'll comment on with the sample size, and this is always the thing related to any of the work that we do, that it's harder to engage with the user community. But what I will tell you here is that the users who have participated in this process and the ones that we have scheduled to interview are people who you would expect would have significant influence. So think of those users as kind of nodes in the user community, that they really act on behalf of a whole range of other users. So it's a little hard to equate one user with that level of expertise to a different type of stakeholder, for example. The other thing I'll point out related to the whittling of the process is that when we look at the people who responded, well, of course, we wouldn't talk to the 20 people who told us they didn't use pension and OPEB information, but we wanted to cast that survey wide because then you kind of find out of that bigger group how many people are not using pension or OPEB information at all. And then, of course, like as we whittle it down and you get closer to the bottom of that analysis, we're also not going to force people to interact with us who don't want to. We wanted it to be on a voluntary basis. And luckily for us, we had people on that voluntary basis who were people who I would call kind of in that user node group who represented a lot of other users, where a lot of other people are relying on the information that those users put forward in the rating of bonds and that type of thing. So I just wanted that sort of clarification as a counterpoint.
Thank you, Tammy. That's helpful. Bob, is it?
Well, one thing I do want to point out is I noticed governments were excluded. Governments have a tremendous number of interlocal agreements. I once had 20 years of my statewide agent retirement system plan in my office because I didn't think they were using the proper actuarial method. And I'd created Excel spreadsheets and all sorts of other analysis. I have used the regional providers that we have for water and wastewater. I've analyzed their financial statements and I've talked about their interfund transfers and other things. And so please, when you do your research, particularly as you move forward on this, looking at various other standards, don't forget that sometimes we're not just preparers, that we, because of the contracts and relationships and the business relationships we have with other governments, we also will use financial statements.
Joel?
Joel Levy, ICI. First, thank you. This is a very important topic, and I think it shows that I'm getting old, because when I first sat down at my seat at Nuveen 15 years ago, this was nearly the most important factor. Every single report that I had to prepare, I'm the former head of research, every single report that I had to prepare had to have the funded percentage, the discount rates, and exactly where every entity stood before we did an investment. So I just feel like this is coming full circle. I do think that the importance of this, or the seemingly importance of this, is a function of time. And the surprising thing to me is I really want to ask the analysts who don't consider it important. I would want to know why. And I think I know why. I think it's a function of time, right? We've had a great stock market the last decade or so. Everything is fine. Returns have buoyed a lot of funding, and it's made things look pretty good. And so when things are looking pretty good, we just don't focus on things. That's just how it is. And so I think if I was looking at sampling folks and I said, well, someone who has a 20-year career versus someone who has a 5-year career will have a wildly different view as to what's happening here and why it's important and why it's there in the first place. And so I just think so it's a very important issue, obviously, and obviously you of course think so as well. But I think the type of person who responds, and I respect you can't control that. Whoever responds. I think drastically changes what some of that feedback might be. I'll give you a real world example. I invest every day that I'm not here. And just last week, I didn't invest in someone because I didn't like the funding ratios. Because I looked at the OPEB notes, I didn't like the funding ratios, and I said, no, thank you. And so now, again, maybe that's just because I'm old and I'm continuously looking at it, but this is not something that I think large investors who have been around for a little while are not taking are not paying attention too deeply. They certainly are. I'm concerned this issue will come back in a major way. I think that the market returns won't be great forever. I mean, I certainly hope they do. My retirement certainly does. But the reality is that there will be a period of time to which this will not be the case. And so I am concerned that any kind of stepping back on some of these will be a time when you'll have to consider maybe that was not the best time to do that. I'll also note that a lot of this debt is issued when we have to fund the budget holes, or not budget holes, when we're funding the liability gaps that happens to come usually through the taxable market. I'm lucky that Nuveen allows me to be the world's largest buyer of taxable bonds, and so I say that only in the context of right now taxable supply is lower than it has been in the past. And so it's right around 35 billion, depending upon how you want to calculate it. But the point that I'm sort of trying to make from the investment community standpoint, and I'm probably over my word count, so I apologize. From the investment perspective is right now, folks are issuing taxable bonds and they're able to get a really attractive rate. And a lot of that's based off the supply. And so I think over time that might change, meaning if that supply increases, this will be one of the first things, the OPEB bonds will be one of the first things that receive the largest increase in spread. And so I just want to say that bond analysts care. They cared in the past. They certainly care about now. I, to this day, am making investment decisions based off it. And so, but again, I appreciate the hard work because I also know that this is a hot button item. But I would just be very cautious in what changes you do make, just given how the market is played out over the last decade or so. Thank you.
Linda?
First and foremost, thank you. Survey research in this domain is very difficult. Some anecdotal evidence in the world of accounting, the top accounting journals are starting to really encourage the GMP space to do more research that's survey-based, and it's very difficult to get participants. So I applaud the GASB research team for taking this on. You're in, I was happy with, because we need to start moving the needle on that research front. So thank you. Second comment, I believe it's slide 13 by count. Lisa, it's the where you have the picture of the pension and the OPEB, the step 1 through step 5. I just have one thing for you to put in your thinking cap as you move forward. Psychology literature suggests the more an item is complex, retention can be accelerated the more times you repeat something. So as you're looking at step 2 and 3, maybe capture if there's some sort of correlation, because the more that you have repetitiveness of a topic, people tend to recognize it more. That retention level goes up. It sends more of a signal. So while I think your format is great, I would capture those repetitive pieces, because is it helping people process the information? I think that could be quite useful. So thank you.
Stephen?
Stephen Stewart, Governmental Research Association. Just as a general comment, these are important disclosures, and it's a great opportunity to look at them and see if they're achieving the goals that they are meant to achieve. Our comments are mainly is the amount of information is kind of boiled down into these information items. There's certainly there are those kind of core data points that we all go to, like the multiplier, the discount rate, employee counts, things like that. There's a lot of information, though, that you need to have in the disclosure to understand the context. And so in the surveys that you do as follow-ups, maybe consider how to ask, if someone, says that this information is maybe not the core information they go to, is it still valuable from a contextual standpoint or just an understanding point of view? I would also encourage GASB to, look at options for enhancing the disclosure with things that are not in there right now. If we spent a lot of time in the past, talking about the Social Security disclosure as one thing that's not in there, but is very valuable to analysts and trying to understand supplemented plans versus unsupplemented plans. So I would encourage you to consider that as a possibility if that works. And then I think Bob's comment was kind of an interesting point of view. Because pension plans and OPEB plans are, they're promised benefits for the future, government employees and statement preparers would probably have an interesting perspective that if there's a way to reconsider that as maybe a separate track or a separate element of this, that might be interesting perspective to have.
So in the interest of time, is it all right, Lisa, if I ask folks maybe to connect with you offline just so that we can, I know there's shuttles and stuff that are happening and I want to make sure that I'm not keeping anyone from getting to an airport and things of that matter. So if that's okay, is that all right? Okay. Thank you for, again, I wanted to echo the words of many. Thank you for all your work on this important research topic. I'm excited for what's going to be the outcome and grateful for the engagement that you're getting and looking forward to the next round and what the report back will be. So I know there's a lot of interest in this. Given that we are out of time, I'm just going to quickly say we didn't have an executive committee meeting, so I have no report to give there. So it's an easy update, but I did want to carve out a quick moment and just express on behalf of the GASAC our appreciation for our outgoing Vice Chair Jeff Praviti. He has been such a key member of our Aaron said it well earlier. You've been such a leader in governmental accounting and financial reporting. Just appreciate that all that you've done, and hopefully we'll get a chance to cross paths with you again in the future. And just wish you all the best. So thank you again.
Hey, Rob.
Yes.
I'm going to do this real quick. She's going to get mad at me later for it. But for those that don't know, this is the last time we will see Roberta in an official capacity in front of GASAC. If you don't know, Roberta is retiring. And so if you didn't know, you now know. I just wanted to tell everybody in the room that. And so if you do see her, say congratulations to her and wish her a great time in retirement. But this will be her last GASAC meeting.
And wish you the best to Roberta in retirement. That's very exciting. You'll be missed. Thank you for all your contributions to our industry and financial reporting and accountability, the work that's been done. Safe travels, everyone. Blue Sheet has the next meeting for us. So make sure that you put down on your notes. Our next meeting will be October 26th and 27th here in Norwalk. And then we also have the 2027 date. So please mark those as well. Thank you, everyone. Safe travels.